Ladies and gentlemen, and welcome to the Retirement System Investment Commission meeting of Thursday, April 21, 2016. First order of business is to call to order on our consent agenda. Motion one is to adopt the proposed agenda as presented. May I have a motion? Second? All in favor? Opposed? It is unanimous. Second, the commission approves the minutes for the following commission meetings as presented January 4th, 2016 and February 4, 2016. Do I have a motion to approve? Second? Second. All in favor? Aye.
I think I need to abstain because I don't think I was at one of the meetings.
Okay.
I think so.
All right.
February
Yeah.
Yeah, I think it's
Yeah.
for,
Yeah, so I'm going to abstain.
Okay. Any opposed? No opposed? It is carried.
Alan, I think it was the 24th,
Yeah.
because we had two meetings in February.
Oh, okay.
I think it was the
I think it was
24th.
the second.
It was the second one, I think.
All right. Well, you can still record me as an abstention. since-
Gotcha. Just in case. Just in case, all right?
Now we will move on to the chairman's report. Mr. Hitchcock, do you want to read that motion?
Well, Mr. Chairman, the first item under your report would be the distribution of the commission evaluation discussion guide. And I think this year, there's some thought to do that a little bit differently in the form of an online survey. And I believe Mr. Farmer can give us just some brief comments on that. So, Mr. Chairman, if you want to recognize Mr. Farmer.
Mr. Palmer?
Thank you, Mr. Chairman, members of the commission. So as you recall from the last several years, you've received a paper pencil self-evaluation. And so this year you'll receive an email from me via SurveyMonkey. So the same questionnaire will be in the SurveyMonkey structure. But if you will be so kind as to, and you should receive it today, as a matter of fact, complete it quickly, I'll be able to provide you the information ahead of the June meeting. Thank you.
Mr. Chairman, I can assure you that SurveyMonkey is a much more legitimate source of doing this type of thing than the name may imply.
Why do they call it monkey?
Not exactly sure. So, yeah, that's just what that's just.
No reference to us.
No, no,
No,
it's not
all right.
we're not, I don't think, we're not the, hopefully, we're not the monkeys. So, we're just the ones being surveyed, or you're the ones being surveyed, so.
All right, now we're going to move on to, let's see, nominations, Mr.
Yes, sir.
Hitchcock?
Yes, sir, Mr. Chairman, and the next item under your report would be nominations for chair and vice chair. And just to remind everyone, I believe it's the practice of the commission that the commission would nominate both for chair and vice chair at this meeting, and then come back and vote on those nominations at our scheduled June meeting. So, and I believe the first item would be a motion to nominate for chair of the commission.
We have a motion?
Mr. Chairman.
Yes, sir.
I would like to nominate Dr. Rebecca Gunlogson for the position of Chair of the Commission.
We have a second? Okay, the motion's been made and second to nominate the good doctor as chairman. Any further nominations? Hearing none, all those in favor of the nomination?
Well, we're
Good,
not
we-
going to take any action, we'll just.
Oh, okay,
Yeah,
we're going to do that next,
Yeah,
do
we'll
that next time?
Yes, sir.
All right, fine. So the next one is for the vice chair?
Yeah, the next will be a nominations for vice chair.
Do we have a nomination for the vice chair?
I would actually like to nominate Dr. Ron Wilder for the position of vice chair.
Very good.
For a second.
And a second? And are there any further nominations? If not, all those in favor?
Well, we'll do that again. We'll do that
Again, sorry. So keep slipping into the votes, but we'll do that. Is there any particular reason we do it
I
at the
believe-
next one rather than this time?
Yes, sir, and I believe that the custom and practice has been to do the nominations at this meeting to allow, not that our stakeholder groups aren't necessarily familiar with all of the members of the commission, but give them an opportunity to meet them if they would like, talk to them, that kind of thing, and be able to weigh in a little bit on the folks that are being nominated, and just kind of give them an opportunity. It seems like it is going to be a heavily contested election, so they probably need to think about campaign committees and that type of thing as well. So,
No campaign
yeah,
contributions.
Just give them some
All right.
time to organize their campaign committees. So,
Okay, then we will now move on to the CEO's report. Mr. Hitchcock.
Thank you, Mr. Chairman. For purposes of my report, before we get into the Iran and Sudan divestment policies, just give the commission a little bit of an update. This week has been somewhat busy for me and some of the commissioners and as well as Mr. Berg in appearing before a couple of committees of state government. We appeared before both the State Financial Affairs Authority as well as the Senate Finance Committee, the State Fiscal Affairs Authority on Tuesday and the Senate Finance Committee on Wednesday. I believe that we had some robust discussion with the members of both of those bodies, and I think it was some good back and forth. I think it gave us the opportunity to explain not only where we've been as far as our performance and asset allocation and those types of things, but I think it also gave us an opportunity to explain to both of those bodies where we believe that we're going, hopefully with the portfolio and in an effort to ultimately improve investment returns, but also we try to also strike a very cautious tone that regardless of really who you are or what pension fund that you are and how you're invested, that the near-term market conditions are going to prove significantly challenging for any pension fund to hit its assumed rate of return. So I just wanted to update the commission on that. Also, the next item under my report would be a motion to approve the Iran and Sudan divestment policies.
Mr. Hitchcock,
Yes, sir.
may I ask a question along the lines of updates?
Yes, sir.
Could you give us an update on the search for the CIO?
Yes, sir. We'd be more than happy to. I believe we've gotten to the point in procurement where the charging meeting is next week, next Tuesday. We've received solicitations from vendors, or procurement has. I believe that they'll be presented to an internal panel, the way that it works. And Betsy, please correct me if I say anything wrong, but they'll be presented, those vendors will be, for the headhunter, the search firm, they'll be presented to our internal panel next week. And then those, basically all of those solicitations, that internal panel will score it. Those solicitations will be presented to me. I'll go through all of them, and we'll select a vendor. So, but at this point, because of the way it works, I'm not aware of, who's submitted and, the proposals and that kind of thing because of the way that the state procurement rules work. So, but that's the point where we are right now. Yes, sir.
Could you update us on the Senate Finance Committee? Y'all met yesterday with them.
Yes, sir.
You didn't just do that, did you? You talked about,
Yes, sir. I was kind of lumping both in. So,
could you talk a little bit without getting yourself in trouble about the reception there? 'Cause it was quite different from the reception that
I think I termed both of the discussions as robust. So, and just for the edification of the other members of the commission who might not be as familiar, the Senate Finance Committee is basically half of the Senate because, as a member of the state Senate's 46 members, everyone has to either serve on Judiciary or the Senate Finance Committee, and they're in the middle of the budget debate right now. And, one of the things that the House has proposed, or has included in their budget is funding a 0.5% increase on the employer side for contribution increases. And I think based on our discussion at the SFAA, Senator Leatherman wanted us to come over, talk about, where we were, both from PBA's perspective, receive some information from the actuaries, and Peggy did a good job relaying that information to the committee. They also wanted to hear from me. They wanted to talk about our relative performance as to our peers, how we've underperformed our peers over the past several years, what the reasons for that were. And I mean, there were some very tough questions in regards to that, and they were very interested in where we're going and what the impact really is on them as budget writers and also on state employees as well. So, like I said, some, very tough questions. I think we answered them with what I hope is a significant degree of candor. And, there's a, I think, as you know, we are where we are. This is really the unfunded liability that we have is something that's 16 years in the making. 16 years ago, we had 1 year of unfunded liability. Now we're at, where we are, I guess in all in, somewhere around $20 billion or so dollars. So they want to know, they ask our questions, they want to know how that happened, and I think we owned our part of where we are, so.
I can't argue with any of that. I think both of you have been forthright about it. There is always a complicated subject with people who don't deal with it on a daily basis. Lord knows I've had my trouble and I deal with it on a daily basis. There's a knowledge gap and there's a context gap. And I think the reception of the authority was that something needs to be done and the sooner the better. We talked about what it costs to delay those opportunities. At the Senate Finance level, I didn't hear any urgency. And I'm not trying to portray that I know exactly what they're going to do, or because I can't. But I was bothered by that because they look at the budget on a yearly basis, but this is a debt that can't be looked at by. And if we miss that opportunity to pass, if we miss the opportunity and we pass on the opportunity to put more funds into the system this year, it will cost us a tremendous amount in the future. And it only gets worse. And the argument that state employees will have to pay more if we raise contributions, well, they're going to have to pay more next year. I mean, except we just have to pay more because the credit card interest just keeps piling on. So how that affects, I think, and the reason I bring that up here is because it's going to affect us, right? Or maybe y'all, the commission. If nothing is done this year, well, the next year, your bogey's higher. And you're going to fall further behind. You're going to have to take more risk. And then if nothing's done that year, we're now in that vicious circle where the kid who got out of college is finances his house, his condo, and a credit card, and you can't turn that back at some point. I feel we're already at that place now. But I do want to thank you all for standing there and answering the questions forthrightly. Peggy's been forthright with me about saying the system needs more money. You've been talking about that. I don't want to put words in anybody's mouth, but we just have to go there. And I think as a commission, we should understand that, for Alan and Dr. Wilder and everybody involved, next year, your hurdle's even bigger than this year, and we can't make it this year. So what's going to happen? We add to it, and that's what I think is relevant to this meeting. Thank you.
Yes.
Well, and I just want to add that I think the treasurer has performed I think a very valuable service in pointing out the deficiencies that exist and what he thinks, not only he thinks, but what should be done. And we'd all like to have the world as we would like it to be, but unfortunately we have to deal with it as it is. And I think the treasurer has done a great job in pointing out what should be done, what needs to be done, and hopefully we can all do our part. But thank you very much for what you've done. So, now,
yeah,
let's see, Mike, what,
I think where was it? The Iran and Sudan investment policies,
you
and
need to read that motion.
yes, sir. And just to remind everyone on the commission, these Mitchell Goldsmith presented on these policies at the last commission meeting, and I believe that they've been posted. And as far as I know, we have not received any comments on those in the intervening time period. So at this point, Mr. Chairman, I think it would be, pending any further questions, I think it would be in order for us to move to approve those. And
Morning, this Reynolds. Sorry I'm late.
Okay, we hear you, Ernest.
and if you would like for me to, I'll go ahead and read the motion.
Do you feel it necessary to read it, or do everybody's had a chance to read it, just take a vote on it?
I don't, that's.
Do we need to read the motion, or has everybody had a chance to read it? All right, so-
And the motion is in the motion packet, Mr. Chairman, so if someone will make the motion, we
All
can.
If we could have a motion to approve, please.
So moved.
And second?
I'll second.
All right, motion's made and seconded. If there's no further discussion, all those in favor?
Aye.
Aye. Any opposed? None? Okay, the motion is carried.
Now, Mr. Chairman, the next item on the agenda would be the acting CIO's report.
All right, Mr. Byrd? There you are.
Thank you. I'm going to ask Tim McHenry to begin with a discussion of the economic environment prior to my comments.
Good morning. So we only have about 5 slides here, but hopefully they'll be informative as we lead into Jeff's conversation. This first one here just looks at the overall economic highlights, I guess this one and then the next one as well. During the first quarter, U.S. equity markets were up just shy of 1%, up about 90 basis points. The market rise took place against a background of diminished expectations. So the estimated economic growth for 1Q 2016 shows modest signs of slowing, which continued the trend from third quarter last year to the fourth quarter of 2015. If you look at consensus forecast, it points to below average economic growth, but steady economic growth in the U.S. throughout 2016. This next slide here, the first one, I guess on the top right there, in reaction to slower economic growth, the Fed did come out and release a statement showing that they would likely take longer to raise rates than the market had previously thought, or I guess is what they previously thought. However, it does fall closer in line with the market, what the market has thought. So the top right graph there kind of shows that. As a result, we saw the U.S. dollar trade down. You can see that on the bottom left graph. However, oil did rebound, and it did somewhat show a bottom there, rallied in recent weeks, which is a positive sign for markets in general, but particularly emerging markets. So slide 3 here focuses on U.S. economic growth. Economic growth in the U.S., or the outlook, does seem pretty healthy. The top graph there shows manufacturing as well as service sectors rebounding in March. Unemployment remained broadly unchanged over the quarter, about 5.5%. And we think that inflation expectations or pressures are going to remain broadly in check for the next couple years. So overall, this does paint a picture for expected continued moderate growth in the U.S. Now shifting over to non-U.S. developed economies covered by the EFA regions, growth momentum did slow, which you can see from that top graph there. On the right, you saw growth amongst the EFA regions fall towards the right end of that graph there. We expect low inflation for much of this year, but also oil prices will play a key role here. Monetary policy continues to be more accommodative in EFA regions relative to the U.S. Recently, policy statements from both the ECB and Japan indicate further monetary stimulus is on the table over the next several months. Overall, we do expect easier financial conditions to support non-U.S. developed equities and non-U.S. developed economies, but we do recognize there's still a lot of geopolitical risks out there, specifically Britain's potential exit of the EU, which the vote's going to occur in late June. Another one would be just general friction in the Middle East.
Just on that point, if Britain were to exit the EU, do you, in your judgment, would have any effect or on our economy in any way?
I think there's certainly a trickle effect. Anytime you have big updates like that, as far as the measurable impact, I can't give you a good number. But I think come June 23rd, I believe it is, when that comes out, or leading up to that, I think we will see some trickle effect into the U.S. economy. So I guess summing up a lot of these comments, one of the things that we do is we try to put together a medium-term view, which is a 3 to 5 year forecast. How would this impact equity market returns? So we do think that EFAs are posed to, or EFA regions, developed non-U.S. equity regions, are posed to outperform U.S. equities marginally, just given valuations and the earnings outlook being better placed in these regions of the world. And then my last slide here just focuses on emerging markets. And we did see, as you can see, or maybe not shown quite on this graph, but growth in emerging markets continue to weaken. China continues to be attracting a lot of attention. In aggregate, the growth differential between emerging markets and developed markets is likely to widen in favor of emerging markets, and that's the graph there on the top right. Recent oil price rallies and the statements by the Fed did trigger rebounds within emerging market currencies, which you can see on the bottom graph there on the right, which should be seen as a step towards stabilization for the emerging market economies. We don't expect continued or sustained outperformance, but we think near-term conditions have certainly improved. There's a lot of better economic numbers, stimulus in China, stabilizing commodity prices. All of these have helped emerging markets outperform year-to-date so far this year. Through the first quarter, emerging markets are up about 5.7%. So we did see quite a rebound there. That wrapped up most of my prepared comments, but if you have any questions, happy to answer them. All right, thanks.
If I could get the clicker. Well, while we're, thank you. Let me give just a little bit of kind of market color to help provide a backdrop for what's going on in our portfolio for the fit. So that Tim focused primarily on Q1. I'm gonna back up and I'm gonna give fiscal year to date through February. At the end of February, for the 8 months of the year, 2/3 of the year so far, equities were negative across the board. S&P being the least painful of most markets, being down only 5%. Emerging markets, we have just been decimated at that point in time, down at 25%. A number of factors there. Developed markets down 14%. But each of these, it should be noted, since the end of February has had a nice rally. The developed world, think of that as a 10% rally. Emerging, think of that as a 15% rally over effectively 7 weeks. Government bonds are interesting, to say the least, across the world. If you own the 5-year government bonds of France, Germany, Sweden, the Netherlands, Switzerland, or Japan, you're earning a negative interest rate, which is a very foreign concept historically for us. In the U.S., the curve has flattened during the year, both the front end rising by about 20 basis points and the belly of the curve from kind of 5 to 30 years flattening by about 40 to 50 basis points. So at the end of February, you have the ability to invest in the 10-year at a yield of 1.74%. So as we think about building a portfolio to make it work, this is obviously a challenge. In credit markets, investment grade spreads that started the year in the neighborhood of 70 basis points blew out to about 125 basis points, a lot of that being the materials and energy complex. They ended February at 108 basis points. Since then, they're right back to where they started the year, basically about 73 basis points. High yield started the year at 300 wide of treasuries. That went out beyond 600 basis points. Some severe impairment in the high yield landscape, ending February at about 520 basis points over treasuries of yield. Since then, they've tightened another 100 basis points, so there's been a nice recovery since the period of time that we're about to look at our portfolio performance. So to summarize, and to summarize somewhat bluntly, if it wasn't investment grade fixed income or real estate, you lost money. So let me shift now to our, well, before I do that, are there any questions about kind of the landscape? Okay. So This is sort of an off-quarter performance update, so this isn't going to be as deep as we normally do for a quarter end. But I do want to spend some time here because February really does give us a very interesting opportunity to look at our performance and ask ourselves questions about how does our portfolio perform in a difficult environment. At the end, I'm going to highlight a few things that really aren't working as well as I'd like them to and share with you kind of our plan for addressing these things. But let's start just with the asset allocation. At the end of February, you see, generally speaking, we were overweight risk and underweight cash. Some of this just relates to the timing of cash flows for some things where we reduced or funded a manager at the end of the month. But most of the overweight to risk you find in the credit space, which has, since this time, worked quite well. Here is just the general performance. I'll call your attention to the fact that on a fiscal year-to-date basis, we are not outperforming our benchmark. And we're going to get in, that's where we're going to spend most of the time here. Here you see just the kind of gives you the understanding of the link between where we started the year and where we are now. We've paid out $700 million of net benefit payments. The investment performance being negative, obviously, is as we discussed, markets not providing really any meaningful help to us there, but compounded by the fact that we're not performing as I'd like us to. Here we see performance versus benchmarks for each of our asset classes as of the end of February. There are a lot of numbers here, but I'll just call your attention briefly to the last column. The 5-year returns. There are 2 asset classes that have where the market benchmark gives a return in excess of the assumed rate of return, and that's private equity and real estate. So this is, if you were to break apart the global equities and look geographically, you would have a third asset class, and that would be U.S. equity at earning 10.1% over the last 5 years. So this shows us how we're doing against our benchmarks through the first 8 months of the year. Some areas we're doing well, and we're pleased about that, but what really should catch your eye here is the 3 asset classes on the right, and that's what I want to talk about. So let me start here with second to the end, mixed credit. Our performance in mixed credit is not to my liking, it's not to anyone's liking. And we're getting to the point now where we're close to, well, we're 2/3 of the way through the restructuring of this portfolio. So think of it, baseball terms, we're in the 6th inning of making this better. We've gotten the majority of the assets consolidated with our highest conviction managers, including 3 managers that have been approved here during the last year. We're now shifting our focus to high yield, where we're going to be looking at whether we need to make some changes there. At the end of the process, where does this take us? Where does this restructuring leave us? I think it leaves us with a portfolio that will perform better and cost about half as much as the portfolio that we kind of inherited in this process in 2014. Next, our GAA portfolio has had a very disappointing 3-year period. Right now, Brian Moore and I are working to evaluate different options for us here. We're working with HEK to look at the different products and solutions that they see as appropriate in this space. This is most likely going to lead to a search being conducted. Yes, sir.
It might be helpful to a lot of people here to if you could briefly define exactly what that is, so there's an.
Oh, GAA?
Yeah.
This is basically an asset class where normally we allocate the assets, And this is an asset class where you hire a manager to do so a bit more dynamically. So and what we have here is we have really 4 pieces. We have 2 outside, or 3 outside managers doing this, and we do use the overlay in this as well. So this is, what you're seeing here is performance largely due to, I shouldn't say largely, a lot of this underperformance is due to some of our managers being very early into emerging markets. So as Tim alluded to, that it's been a very difficult space owing in no small part to the erosion in the commodity landscape. So the emerging economies would tend to be more dependent upon commodity exports for their kind of health and well-being of the economy. So those equities have been beaten up very badly, as has emerging market debt over the last, well, really since 2011. So some of this underperformance relates to just being very early there. And another element of our performance here is that we use risk parity, which is a very different type of investing. And risk parity tends to not do as well when you have periods where equities outperform fixed income, because you're seeking a more balanced risk approach, equities contributing a lot. So that's another flavor of the underperformance there. Suzanne, do you have anything you would add to that?
No, I think it's a fair discussion, but it does incorporate a lot of things. The key issue, though, is there's variable asset allocation choices. So over short terms, it can sometimes be a difficult thing to measure, but I think Jeff's hit the nail on the head that they haven't done well over the longer period, so it does really need to be revisited across the board.
Yeah. So that's going to lead to an internal kind of reevaluation of the entire asset class. Then third, our private debt portfolio has underperformed in a big way this year. The story here really is that a number of our managers invest in lower quality, more subordinated types of credit securities, or directly lending to companies that are maybe of a lower credit quality. So Adam has been working to bring more balance to the portfolio by focusing his efforts on higher quality, more senior debt strategies, but we're not there yet. So, but that's something that we're going to see in the not too distant future. And you're seeing this effect in February, and if we wait till March, you won't probably see it as strongly as you see it right now. And this is the think lower credit quality being the theme in both mixed credit and private debt.
Yeah.
The mixed credit portfolio having a component of it that is effectively AAA mortgages, but we're not investing in credit in order to invest in AAA mortgages. So our implementation has been in lower credit quality securities than that, and that's had, it's not the only cause, but that's been a meaningful cause.
Have we
Of
specifically chosen
underperformance.
managers that were investing in that segment of the debt market, or did their mandate wander from what we had originally?
So, no, the mandates did not wander. What we've been doing, especially recently, has been very intentional in this space. You think about this being a return-seeking asset class, that's not really consistent with the AAA mortgages. So this is something that we're actually, when we get to benchmarks, we're going to address this, because the way I view it is if I take meaningful credit risk, but I'm being compared against a AAA benchmark, my performance is not necessarily going to make sense all the time. So we're just choosing to remove that so that the risk that we are taking in the asset class is more appropriate and more appropriately tied to the benchmark. So it's just but it's important to understand, but to your point, this is not managers wandering off away from what we believe they or told them to do or believe they would do.
Jeff,
Yes, sir.
This has always been a good asset class for us, and I always thought that.
I'm
I
sorry,
think
which one?
Credit, private debt.
Private debt.
Yes, private debt, yes.
Well, and that mixed credit has as well until recently. And I thought that, we got into it, you know, and I think I remember Bob saying this once, is effectively, the further you got away from the 2008-9 period, the more dicer it would get, because there were just a lot of opportunities. That's why he got us into it
Yes.
early, and while we made a lot of money off of it. But is it now, if you look at these same assets that are trading in much smaller blocks now, and kind of frozen up in Europe already, is it a symptom of the big managers have picked the best of these deals, and now the pension plans have been taking kind of the leftovers? I mean, I was reading some of the Financial Times or something, and that was what I took away from it. He never said that. Because there are so many big players in the space, right? And now that they have these insurance companies that are offshore, they all need these assets for themselves, that we're getting maybe not the quality that Bob and Herschel and those were able to get to start with.
I have not seen signs of that. We do always pay attention to the allocation policies for when there is a good deal, and we invest. So we invest with several firms that are very focused on kind of difficult credits because they can do it, and they can do it well. But we are always very concerned with whether or not we're getting the good, slices of the pie, or if we're getting the leftovers. So that's something that we have to look at, and we do look at regularly. And one of the ways that we do that is we look at our performance versus the performance of other products. There are ways that you would expect to see that. But I'm not aware of us seeing that in any meaningful way here. Really, in this downturn, it really is, and I've grilled Adam on this on a few different occasions. Show me that what you're telling me is the problem is the problem. And it really is the lower in credit quality, because that's where they can differentiate. That's what we're seeing. And as a result of being in those very difficult types of workout situations, sometimes you wind up with equity, right? That's the beauty of being a lender, is if things go wrong, you don't necessarily lose your money per se. You become the owner of the company. So in some cases, firms like GSO have wound up in that position and making money through that reorganization and coming out ahead with how much equity value they have. So some of what you're seeing here in private debt is the fact that, yes, they wind up with equity on the other side at a time when equity markets have taken a beating. So there's an element of that to this as well. So.
If I could add a comment on the mixed credit component, and first of all, I'd like to just say I think it's wonderful that you're looking at February performance, because honestly, once we do look at March, and we don't have those numbers yet, but I anticipate that all three of those materially red bars will look much better, because we did see a massive reversal in the markets in March and April so far. But mixed credit, it's an excellent point, Treasurer, that we did have a tremendous amount of opportunities post-financial crisis. It was a much easier environment to be successful in mixed credit because there were so many dislocations, and it was, I wouldn't say it's simple to take a good position there, but it was much easier back then than it is today. So the opportunity sets evolved, and we did consider that when we were looking at asset allocation choices. One thing that I think offsets that a bit is that as we've restructured your core fixed income over time, that's become a more conservative pool, and this has been more the place that you take credit risk rather than in your core fixed income component. So the two together, I think, have effectively reduced a bit of the credit exposure as opposed to where you were in 2008, 9, 10, to make it a little bit less reliant on that. But there's no question that the opportunities have evolved there. They're not as easy as they once were. But the managers that you have, I think, are very well positioned to compete with other players in that space.
And who manages private debt for us?
A number of firms.
Yeah.
I mean, no, in office, staff.
Oh, Adam Jordan.
Adam, good. I'm talking to Adam.
Well, can I answer a question where I thought you were going to go, which is, you point out, I think, very appropriately that back in the financial crisis, there was a really compelling opportunity to take credit risk, as opposed, and that was the moment when we took credit risk and de-emphasized equity risk. I thought what you were going to ask is this still worth it to invest in private debt? And the answer is yes, and Steve Marino, who actually is in charge of our mixed credit, he actually keeps telling me we should be doing more in private debt, seemingly at the expense of his asset class. And the reason is because the lending infrastructure, the banking infrastructure, is no longer there in the way it used to be. So now what you have is you have kind of the reformation of the credit markets happening really with a de-emphasis of the importance of the banks. So it's investors like us that through these funds and through these ways of getting to these opportunities are kind of making up for the banks pulling back from lending the way they used to. Now, what happens in the future? We have no idea. If you recall, when we talked in the Bataan Death March of me walking everyone through the challenging beliefs output, one of these related to private debt. And the big question that we all have is this going to be an asset class? Or do the banks come back? So we have to watch what's happening in the landscape, and to maybe directly address your question, to figure out when these opportunities are no longer going to find their way to us, but the banks will reposition themselves to exploit these opportunities, because they are quite lucrative simply as a result of the banks not being there. You would expect at some point the banks, because they're nothing if not smart people, they'll figure out a way that they can kind of come back to this opportunity.
I guess the
perhaps.
root of my question was the delivery and distribution system is the ability for the big banks and others to pick it clean of some of the best assets before they get offered to us. Has not really been the case in the past, but I think now, because it could be that problem. And
Well,
that's something added to
yeah,
that
that's
work.
on us
Yeah.
to be
And it's
recognizing
gonna be a
that.
difficult choice, because it's one of those things,
Yeah.
you find out a year or two later that, all of it suffered.
Yeah.
But they all suffered equally.
But this goes back to, our assumptions, right? Credit is a cyclical variable. But there's never been a credit cycle that doesn't hit equities, right? So your credit risk is greater in your equities than it is in your credit, right? Always has been, always will be, right? Particularly if it's on fixed assets. But I do think it's an important asset to stay close to, because it's definitely changing, right? Like if you look at auto loans, right?
No
And
question.
because of what the Fed's done, right, and because of some of the peculiar stuff, coming out of the crisis, banks have exited, so that does extend the opportunity. Some GE had to shrink, right, that extends it some. CIT had to shrink, right, they did a lot of small business credit, but credit has definitely, if you look at just autos, right, the loans are longer, right, because there was a one-time improvement. People got rid of their house payment, but they kept the car, right, so it was a one-time improvement in credit quality. Right, and I think the important thing is not to overpay for a one-time improvement that can't be repeated, right, in asset classes like that. But I think, that's kind of what we saw in the equity markets, right? High yield been tanking for a while, and then eventually equities caught up in February, right? And we lost a lot more in equities than we did in credit, while credit was dislocating, but that was 6 months in the making, right? So
It finally spread.
it finally spread. That's right. It always does.
I was a little surprised how fast the private debt and how fast it went south and how large it went south.
Right.
I would have thought it would be taking longer, but I don't have really a lot of experience in that. I just noted it and thought, well, that was pretty fast.
Well, lest you had any doubt as to whether or not our private markets mark their books, there's your answer. So, and you make a great point. I don't want to lose sight of the fact that private debt and GTAA have been very good, and still over longer periods of time have given us good returns, especially relative to the benchmarks. So I don't want this to sound like an indictment of the asset class, but by the same token, the last 5 years have been a fairy tale for equities and credit. So what this may be is these asset classes are now waking up to the reality of a more difficult economic environment. So there's a certain amount of this that, while it's the end of a period of calm, perhaps, this is actually not abnormal
That's right.
at all. This is perhaps we're getting back to a very normal type of risk environment. So last thing I want to point out here, or just point to have a discussion about, is I want to share with you something where we're taking some action even though you wouldn't necessarily, from looking here, be asking the question. Our real estate portfolio, and Eric Ravelli deserves a lot of credit for this, has done very well, and specifically very well over the last 3 years. Alarmingly well, you might say. So coming out of the Great Recession, as you may recall, and for those of you that are newer, maybe this serves as prelude, we built our real estate portfolio focusing on seizing the opportunity of a very ugly end to the prior real estate cycle. So we focused on opportunistic strategies, which are the higher octane strategies. And we've done very well with this approach, especially in recent years. But now that we're getting later in the cycle, we're having some different conversations internally, and we're shifting our focus to the core and core plus type strategies in an effort to walk the portfolio risk back to a level that is more befitting being later in the real estate cycle. So I want to share this with you so that you understand kind of strategically how we're thinking about real estate. And also, you know, we're trying to be thoughtful and proactive in this area. So I just want to make sure that that's clear and that comes across. So are there questions on any of what we've hit on here? Okay. I'm going to shift gears here, and I'd like to talk a little bit about something that we're doing. It's a project we're undertaking to do something a little bit differently, and it relates to private equity. As you recall, when we went through the challenging beliefs exercise on an array of topics that included private equity, we ultimately eliminated the static target for private equity and instead adopted a floating target. And we did this with the goal of investing with those managers in whom we could arrive at a very high conviction level. So what I want to do here now is just kind of start to ferret that out a little bit for you. And I want to follow up on the concept and give you a better sense of what we're working on and how we think this looks. So I'm going to use an example here, but in a moment. But when we evaluate a manager's track record, we're going to go deeper with our analysis. I think that's appropriate. We're going to strive to really understand what are the levers that these managers pull in order to drive value creation in the companies that they own. So what do I mean by that? Different firms pull different levers. They have different skill sets, and different firms pull on different levers to earn the returns, but we don't necessarily value each of these equally, and there's a good reason for that. So I'm going to explain using an example, so I apologize for reading here. Suppose you have two different managers with very similar track records over the past decade, over a few funds. Manager A, let's say when you peel back the onion, you see that what Manager A is really good at is buying good companies at good prices, and then maybe using more debt in order to drive a higher return on equity for the investor. Let's compare that with Manager B, who has a track record where they buy poorly run companies, and they achieve an acceleration of earnings by driving operational improvement and disposing of unproductive, unprofitable business units. So let's set those up as firm A, firm B. So it's pretty easy to understand that Manager A may be adding value marginally, but we question whether or not debt refinancing is going to be a valuable value creation lever over the next decade. As we go from rates at nothing to higher rates, adding debt to a business seems like a very unlikely course of action to be a value creation lever. So it's hard for me to assign that strategy meaningful value, right? If that's what we see as the pattern of return generation, it's hard for me to assign a lot of value to that. Manager B, on the other hand, rolling up their sleeves, fixing a business, removing management and causing the company management to focus. That's something that I think is always going to be in season. And there's always somewhere, as evidenced by, well, watch the markets, there's always a business that is being run badly somewhere. So what we're working on right now that I hope to
I've
come
owned
back.
some of them, I know.
I hope to come back in June with more meat on this bone, is we're working on the development of a quantitative framework that'll help us approach private equity in a different way and really understand the value creation levers that each firm is using to drive the returns, so that we can make a more informed decision and find the firms that in whom we have the highest conviction, not only in their ability to continue to generate returns, but also conviction in the way they choose to generate those returns. So I'm happy to answer any questions. I know this is more conceptual in nature right now, but this is where we're headed, because we think this is the right way to invest in an expensive asset class.
Jeff, what do you see happening? There's been lots of talk on fees in general, but in private equity, there's been a focus recently concerning fees. Do you think that going forward that fees in private equity will come down, or is that going to be something that will be more of a negotiated type of situation?
Well, I can very easily tell you my desire. But is my desire going to marry with reality? I think you'd need to use hedge funds as a corollary. As I see it, the broad hedge fund landscape, returns are not at a level that they were 15 years ago, right? So have you seen kind of the price erosion there? Marginally, I'd say. I don't think, certainly they're not going to manage money for what a public equity manager does, because they're doing something very different, and it's much more intensive, time-intensive, effort-intensive to fix a business than it is to own shares of a company and vote, right? So I don't think that there's going to be meaningful improvement there over the next decade. I would like to see a focus on the improvement of alignment, where we get better economics when we're in the third fund with a firm. So these are things that are important to me to push for. But right now, the trouble right now is there's so much money. You got to remember, there's nothing attractive right now, right? So when you think about making a pension fund work, let's think for a second. You have private equity that, how do you guys model it, at 300 basis points better than public?
Generally, yeah.
So when public isn't going to give you that much, everyone's going to private equity right now. So they're having no trouble raising funds. They do not need to negotiate. The premier managers are not feeling they need to negotiate on terms, on cost, you name it.
Right.
So it's a difficult environment for us to employ any kind of leverage to improve the economics there. But what can we do? I mean, I think that's where we should structure this, is what can we do to try to get there, right? Is to you can do two things to take your cost down. You can be there in size and insist that you will only, you don't go looking for one manager, you go looking for three managers, right, that are going to do private equity the way you want it done for you, and make them compete for your capital. Be willing to commit larger amounts to single managers in order to get the volume discount. That's one way. The other way is to take advantage of co-investment, right? Which is, you should seek that at no fee, no carry. So if you're trying to get $200 million invested, maybe half of it costs you 2 in 20, and the other half costs you nothing. So now you're effectively at 1 in 10, and our research that we've undertaken suggests, you need to do it the right way, but co-investment can bring meaningful value to your plan simply by scraping away fees and carry. So, that is, how do you get the costs under control? That's a way. Those are two ways.
No one has ever said that hedge fund people weren't smart, but they're also lucky. Not hedge fund, private equity. I've been active on a national level in this, and all across the country, helpful with CEM in this, was there was a real movement, and the private equity guys were all prepared to change the way they were presenting the fees, standardized fees and all. And then when the bottom drops out of the investment pool, all this flood of money, as you just described, comes in, all that work just went up in smoke. And now they're, like you say, they're all just, it's a bidder's war to get into the funds. And that, of course, brings me to the point I think where you're headed is, with all that competition, how are these funds going to actually pay off in 2, 3, 5, 8, 10 years with all the flood of cash? And it bothers me. I don't know how to answer the question, but I do think it was interesting, and because I know that a lot of y'all followed it, to see what was happening on the national level and just the economy turning, and now those very wealthy people can sit back and say, well, thank you.
I do think there is some pressure. So we're talking about fees very broadly here for private equity. Keep in mind, there's obviously a number of ways in which they get paid. There's the fixed fee, there's the participatory fee when they do well, so that's a little bit better aligned with you. But one area that's been a bit in the shadows has been these pass-through fees that exist at the partnership level. And I think particularly public funds in the country have been very strong advocates for, at a minimum, better transparency there. So it's being reported consistently and coming through. You can smile, and that's a good thing.
We had a recent, I'm not going to mention the manager, but we had a recent event where I'd asked a question, staff went to him, tried to find out, and staff kind of came back and said,
It's hard. It's hard to
not
get
gonna
them.
tell us.
And there's pressure to increase that transparency. And where there is transparency, generally there is reductions. So it's not the big fee reduction that perhaps you were looking for, but we do see that as something that is on the rise. On the flip side, the days of negotiating one-off deals with managers, pushing them on fees, those are largely gone with the larger institutional managers. As Jeff said, sometimes you can create very large relationships where you're one of the largest investors and you can pressure fees for that kind of different group or terms. But largely, it is very difficult to do. And that's a good thing. That means you're not in the position of being the person that paid the rack rate instead of pushing them hard. Everybody's getting generally the same fee. But there isn't a lot of flexibility. And as Kurt's pointed out, there is a lot of money chasing it. We have challenges. There are even funds that have increased fees in the recent environment. So it's been a difficult one. You have to be extremely selective in the private equity space to be successful right now.
But this gets to thinking through the trade and the opportunity, right? I mean, there are actually 3 more things you can do, right? You can think, how do I find KKR circa 1978, like Oregon did, right? Not KKR today, right? I mean, so one is you go down market, right? 2, where they're playing, smaller companies that do have more growth potential, more opportunities to close, valuation discounts and the like. So, but most public funds don't want to go down market, but that's what the most likely endowment types would do, right? Is go down market. Second is, to the extent you can, you take your distributions in cash and you hold them. I don't know if you've ever seen the study on the original members of the S&P 500. It's actually outperformed the rebalanced index over time. So if you just bought the list and held it, so the extent you can take distributions in cash, in stock rather than in cash and recycle it, right? You get the benefits of a private equity investment without the recycled cost, over time and reinvestment activity and additional carry, and then three, all the big guys are public. You get more leverage owning their company stocks, which are at the bottom right now, than investing with them, right? To the extent they're successful, you got more leverage in the stock. Apollo's public, Oxif is public, Fig Partners is public, right? KKR is public, right?
Just having a few problems now.
Yeah.
And do we have a concern about just the raw size of some of these funds? Some of them are becoming just huge.
Yes.
Is there a point at which we won't?
We're concerned about nearly everything. So that being one of them. And we've recently, including a fund that you just spoke about a moment ago. There were a couple of reasons why we elected to not even pursue that. We did a lot of work on it, and ultimately, I don't want to say wasted a lot of time, because ultimately we didn't try to do it. But we had our moment of clarity, and it was around, in no small part, that issue. Could not understand why, other than because the market will bear it, why the need to grow the fund by, X percent. We just felt that unless the staffing was in line with that, it just makes, it pools risk in a way that we were uncomfortable with.
And that the underlying investment thesis matches the opportunity size and the fund. So, that's the most common reason for passing that we have in our private equity group right now, is the fund being outsized for where we think the opportunity set and the sweet spot is for that manager. So it's been a very common reason for not re-upping with some managers that have historically been quite successful.
Thank you.
Has the, what do you think the relationship is between some of the significantly large public pension funds pulling out of hedge funds in significant amounts of money? A, where do you think that money will go? And B, will that put, obviously, pressure on the fact that they've underperformed, but will that put further pressure on their fee structure? And does that play into the private equity area? Do you think a lot of that money will will go or has been bleeding into the private equity market?
I'm not privy to anything about where that money is going to go. So
We're talking about a fair amount of money.
Oh, most definitely. So let me. I anticipated this question might come up, particularly in relation to hedge funds. So when you look at, and we looked at, and I don't want to take shots at any other plan or anything, but we looked at performance of their hedge fund portfolio, and one, felt more pride in how we've been able to, earn significantly better returns. And knowing our hedge fund portfolio without a lot of market risk in it. I think that really what it is it's a frustration that's been bubbling over with, look at what we're paying versus what we're getting. And if you look at over the last 5 years, there are lots of plans that, don't have, I'll say some of the luck we've had, some of the benefit we've had of having good partners in the hedge fund landscape. And, we've had a bit of a rough stretch this year, still outperforming the benchmark, but that, I don't want to see negative hedge fund returns. So, that to me is a sign that there is still some market exposure embedded in there that we need to explore right now. But so if you pay hedge fund fees and you're looking at, kind of 3 to 5 year returns of 2%, I think you'd get frustrated, right? And you start saying, if I'm going to spend this money, where can I get a better bang for my buck in terms of excess return? So I think, who knows where they go? They might be drawn to the private debt environment right now, because that's where we would, if we were them, that would be what we would be looking at. I don't know their portfolio. Maybe they're already there. Maybe it goes to private equity. But if your thesis for having hedge funds was, I'm gonna earn a persistently positive, uncorrelated or lowly correlated return, and that just doesn't play out for you, you're, there are lots of areas where they can go that'll be more attractive to them, probably. Depends on how they see the world. My guess would be you will see it probably in the things that have worked well for other investors like us, you know, relative to just owning market betas, you know, private equity, private debt, you know, real estate maybe. But I'm not familiar enough with their plans to really know that, the plans they have. But yeah, I think you're gonna see more of that. Yeah. Because if you look at the benchmark return, there's a lot of people who aren't doing hedge funds very well. So, you know, I don't know why you would stick with it if you don't feel it's working for you. So, and in the case of CalPERS, it was just, they have a hard time getting scale.
Right.
So how can they, you know, what do they have, $200 billion now? 300? Jeez, I blinked. They're up to 300. Who doesn't love a bull market?
Right.
So $300 billion, how do you get $30 billion into hedge funds, right? I mean, these are strategies that don't work as well once they have, you know, a lot of money for the most part. So, you know, it's a challenge. So, and that's, you know, we're looking at that too, even though our performance relative to other plans, I think, has been good for the last couple of years, and our low beta approach has been the right approach.
All right, any other questions for Jeff? If not, I guess we can move on to, you want to take a break, or do you want that interest consent? Wanna do
Yeah, the
that?
interest in,
Why don't you take care of that, Mike?
Yeah. Okay, yeah, I can do these two things. Well, one of them very quickly, hopefully two of them very quickly. So first, let me make you aware, there's a memo in the book. Earlier this year, Entrust Capital, which is one of our strategic partnerships, or strategic partners, announced a plan to merge with the Permall Group, which is a global alternative asset manager that is focused on hedge funds. It is owned by Legg Mason. So these two entities are going to merge. The combined entity will be called Entrust Permall. It will be 65% owned by Legg Mason, with the remaining 35% owned by Greg Heimowitz, who is currently the head of Entrust. The effect of the merger will be to increase the AUM, assets under management, from about 12 billion to 29 billion, which would make them one of the largest hedge fund investors in the world. Mr. Heimowitz will serve as the chairman and CEO of Entrust Permall, as well as the chair of the combined entities Global Investment Committee. The merger, they expect it to be completed during the second quarter of this year. Entrust must obtain the Commission's consent to the assignment of the investment advisory function from Entrust to the merged entity with regard to the Entrust Palmetto Strategic Partnership and its underlying investments. The investment team is continuing its work to monitor the integration, and it will continue to do so, and will recommend appropriate action as necessary if there's anything that's not to our liking. So, Mr. Chairman, there is a motion relating to this action item in your packet.
Motion, Mr. Chair.
I'll go ahead and read it, sure. The motion would be to adopt the recommendation of the acting CIO to, one, consent to the assignment of the investment advisory function with respect to Entrust Palmetto LLC and Entrust Palmetto Strategic Partnership LP from Entrust to Entrust Permall, and two, authorize the chairman or his designee to execute any necessary documents to implement the decision as approved by the commission.
Motion to adopt? Second? All those in favor signify by saying aye. Aye. Opposed?
Aye.
No opposed, it's carried. Do we want to move on to Jeff, AIP?
Move on to the AIP. So thank you for the feedback that we received since the last commission meeting. I want to just talk about some changes, and then by statute, we need to move to adopt the AIP for the next fiscal year by May 1st. So let me just briefly walk through this. I'll go as quickly as I can. So while the list of proposed strategic initiatives was not altered, in response to a suggestion, we added a paragraph providing some additional context for and background information regarding the set of proposed strategic initiatives. On pages 3 and 4, we've added a paragraph that describes an overarching set of objectives for all asset classes, namely to seek to continue the work to consolidate the assets of the trust with those firms in strategies in which we have the highest conviction, and with an eye toward improving the total cost of the investment program. In order to achieve this objective, we will focus on developing a robust assessment of the key value drivers for a number of our investment strategies. We have revised the key initiatives for several of the asset classes so as to better distinguish and identify new initiatives for the coming fiscal year, as opposed to just simply reiterating ongoing initiatives. Other changes in the equity asset class, we've added some lead-in language at page 4 summarizing the new asset allocations increased equity target in fiscal year 16-17, and the role that equity option strategies, 2 of which we're going to present for your consideration in a little bit, will play in adding domestic equity exposure without taking the full risk of traditional equity exposure, and also providing superior returns compared to traditional approaches in both low and negative return environments. So just as a reminder, this is a document that will go into effect July 1st, 2016. I believe we had put for June 30th perhaps, but it is for July 1st. First becomes effective during the next fiscal year. So we're seeking your approval of the AIP at this time.
Mr. Hitchcock?
Yes, sir. The motion would be to adopt the recommendation of the acting CIO and staff to approve the proposed AIP dated April 21st, 2016 as presented, and authorize staff to finalize the AIP by making any technical revisions or formatting edits consistent with the action taken by the commission.
Do we have a motion to approve? Second?
Second.
Okay. Oh, any discussion? Yes.
Mr. Hiscock was on the end of some questions yesterday, which shows clearly that members of the Senate Finance have been coached to believe that if we don't make an amendment, if a member doesn't make an amendment and discuss every facet of this program, then they're for it. So I think that since Senate Finance has a significant part in our life, we need to talk about this. And I'm not saying it's in jest, I think, Ms. Hitchcock, if you could split this document up into 2 or 3 pages and let's go through it line by line or paragraph by paragraph at the next meetings. Because I don't intend to spend the rest of my life fighting a false dynamic that's fed from this office. And so Mr. Hiscock got caught yesterday wondering about who made amendments and how you make amendments. You know, we talked, I think everybody's clear about what I feel about this portfolio, but I don't think that needs to be one reason we don't have employee contributions or state contributions or these other important issues. That doesn't need to be a factor in it. So since you were the one who got the questions, and unfortunately nobody prepped you for it, how do we handle this in such a way that individual members aren't criticized unless we bog the commission down and spend days and days and days and a whole lot of money, because I'm sure that HEK is not prepared to do this for free.
Because I think
Yeah.
Mr. Chairman, Mr. Treasurer, I think one way that, if, in order to make sure that, I guess, that what we could do is we could collate, the suggestions that we got, from, basically in the discussion period. We brought this up at the last meeting, and we asked for comments from commissioners in the intervening time periods. I think we could probably capture the tenor of those comments and suggestions in the minutes, and we could do that by either addendum or however we would do it to the minutes. And also, if any member would have any, would like to encapsulate any, comments or criticisms or whatever, and make sure that that was made part of the record, we could certainly do that as well. So, and we could do that as part of the minutes, which is really are the official record of the commission. I mean, that's thinking off the having about as much thinking off the top of my head. I think that's a way that you could do that.
Can you give us a sense of what those questions were?
Senator Bryant, Senator Massey, they asked me at every budget meeting I go to and anywhere I go, they are members of the retirement system. Put out the fiction that if I don't debate every single point, every single investment, then I have not fulfilled my fiduciary responsibilities. And I'm kind of tired of it. And if we want to, and it's coached, that false dynamic is coached from right here in this office, nothing I can do about it. And so my thought is, we'll just all bog down together and make them happy, right? Because that's what it's about. And I also want, this is a living, breathing document, as we call it, can be changed at any time.
Sure.
I'd like for a member of your staff, I don't think I should have to do it, because I'm not the one coaching the false dynamic, to go through and all of my comments for the last 5 years that are negative or anti our asset allocation or investments, include them in that list. Because I need to show that I have not embraced our assets allocations of the past. And I wouldn't throw this in your lap, except for it's obviously coming from right here. And so I want to find some way to put an end to it, because I don't think the Senate Finance Committee should be bogged down in junk. We have a multi-billion-dollar problem, and this is the last thing we need to be worried about.
Well,
And you don't have to answer me now. I just want everybody to understand it.
Right.
And then, because, I respect you too much to throw it on you.
Sure.
But I want to put it out there now, because I'm just tired of dealing with these other issues that keep us from making progress. So we can talk about it later.
Yeah, I think
I'm
that-
gonna vote against this
Sure,
because
yeah.
of this, obviously.
Sure.
And,
And I think, well, the statutory, yeah, statutorily, we have to have a plan, and I think kind of to reiterate what the treasurer said, I mean, this is a living, breathing document, it can be changed. It can be changed at any time, and any time that anyone would feel, from the commission would feel that there needs to be a change. That's certainly something that can be entertained by the commission at any time. But I think, just thinking off the top of my head, I think the best way to encapsulate, any type of comments or criticisms in regard to the AIP as it stands or as it's been proposed would be to encapsulate the comments and attribute those to, if the individual commissioners are okay with that, to attribute those recommendations to the individual commissioners in the minutes. And then anything that, we can work through, whatever you would want to put in the minutes in regards to any opposition that you have, and encapsulating, I think, some of your previous concerns and comments in regards to, the asset allocation going back, as far back as you want to go. I mean, that's, yeah.
But what we don't want is a series of 5-1 votes over a period of 3 or 4 days, right?
Right.
But if that's what we have to do to make Senate Finance, and I respect Senate Finance, these are elected people from their own districts, and they've been elevated to Senate Finance. But if Senator Bryant and Senator Martin, Shane Martin, if they want to see this, then I think we should honor their wishes, right? We should go ahead and make sure this happens. But I think what you've suggested is a great first start, but I would like somebody to either add the minutes of the meetings or search for my comments, because they're talking about all of these. They're not this document, the last 5, or however many years I've been on this commission. I guess this is my 6th year. So if you could make that happen, I would appreciate
Yeah,
it.
we can work together to
Thank you
figure
very
out
much.
how
I
the best way
appreciate
to record your.
How do people feel about the present document?
Well, can I just clarify one thing, Mr. Chairman? this document should not be viewed as a vote on the asset allocation, right? The asset allocation exists in the SIOP. This is just simply the priorities for this organization to work toward, and I think a lot of this is consistent, really, for everyone. But at the end, maybe this was my idea, so I'll take the full brunt of this. My thought was, I've opened and I assume your staff and others have as well, I've opened the AIP enough times over the last couple of years and searched through the whole thing for the asset allocation, only to remember it's in the other document, that I thought, why don't we have that foundational building block in both documents? So at the end of this document, you'll see the attachment A, attachment B, and these are the things that, once they are adopted in the SIOP, will be reflected here. So, but this document is not the asset allocation.
And I'm gonna bring it up when we get on the other document as well. It's just a false dynamic. It's something that's meant to divide us and not bring us together. It's something to keep an uproar, and it's done by people affiliated with this commission.
Well, yeah, I was gonna say, I mean, the whole plan, when you step back and look at it, right, you gotta say what's the waterfall material decisions, right? And plan design is always the most material decision. And I only bring that up because in the private sector, you can't go buy 7.5% annuity. You can't do it, right? Your quoted rate today would be about 5, right? That's what the private sector is willing to guarantee, right? And
Just as a matter of measurement.
yeah,
Didn't you tell me, Tim, that you just got a 30-year fixed-rate mortgage from a bank at 3 1/4? Oh, quoted, all right.
He's looking for better
And you're still shopping.
Yeah.
Now,
Committed yet.
that gives you some measurement and some perspective on what the rates are and what we're facing in terms of having to invest money.
but yeah, so I mean, so you think of the waterfall plan design that's the biggest rock, right? Asset allocation, then how you implement, is clearly a big rock, right? And then how you actually execute on that asset allocation is sort of the next layer down, right? But I just think that plan design question gets really missed. 7.5%. Yeah, it's a big number.
Okay, I don't want to bog us down, but and when we move to the other document, if we could just kind of, I won't say anything if we don't. Thank you very much.
We'll work together to make sure that,
Good.
Just wanted to clear the way for a yes vote, since we're not approving the asset allocation.
Tracking the fact that as we move along, this can be changed.
Sure, yeah, and I think that, they're Mr. Chairman, as you say, I mean, statutorily, we're required to adopt these things at certain periods of time, but, and I think as we've shown, asset allocation has become much more of a living, breathing topic for us as we.
And I think it's
as we
important.
move through.
Yeah, and I think it's important that we recognize that this will be something in the asset allocation that we will be reviewing and looking at on a much more timely basis rather than looking at it once a year. So it's going to be, should be, and will be an ongoing look at where we are and where we should be going. So, but again, I guess we have to meet this statutory limitation. So, is there anything else we have to, or do you want to read the motion? Or?
Sure. The motion would be to adopt the recommendation of the acting CIO and staff to approve the proposed AIP dated April 21st, 2016 as presented, and authorize staff to finalize the AIP by making any technical revisions or formatting edits consistent with the action taken by the commission. That's the motion.
Motion to approve. Second.
Second.
All in favor, or any discussion? Any further discussion? Okay, all in favor, signify by saying aye.
Aye.
Aye, and opposed?
You said aye twice.
Oh, I'm sorry.
No.
So, all right.
Yes. Right.
Motion's carried. Okay.
Mr. Chairman, there's one final part of my remarks that I'm actually going to outsource to Suzanne, which is a preliminary discussion of the work we've been doing together on benchmarks. And just as a quick setup, one of the things that is important to me is that we look for ways to improve our benchmarking, to improve the alignment with our portfolio, to effectively raise the bar. And that's something that Suzanne and I have shared, and Tim and Robert and I have shared a goal here to improve the way that we benchmark the portfolio. And there are some early things that we want to just offer up for discussion. There is no vote on this, but I want to turn it over to Suzanne to share some of the work that the results of the work.
Thank you, Jeff. So this is a relatively short presentation. As Jeff was mentioning, this is really intended for discussion. We are not asking for a vote here today, but since we are looking at identifying and potentially selecting managers today in some of these newer mandates, we thought it was essential to get in front of you the proposed benchmarks that would be going with those managers as well. And then in June, we'll ask for a final vote on these areas. So I do, of course, welcome your feedback here today, or if you happen to have thoughts in between now and the June meeting, Jeff or I would be happy to address those. So obviously we've looked at some new asset classes or categories to be including in the system going forward. We think it's essential to benchmark those. Also, we thought it's always good to refresh one's view on existing benchmarks. Is there any improvement in the marketplace? Has the asset class evolved? So we should be maybe looking at it a little bit differently than we once did. So we did really give everything a fresh look. I will underscore that none of our recommended changes here are retroactive. Any benchmark change that we would ever recommend is always from a point in time going forward. So there's no, gaming, if you will, of benchmarks. And we would look at the fiscal year as being our inception. So hopefully at the June meeting we'll get these approved and we'll go from there. So benchmarking can be a challenge. There are lots of areas such as hedge funds that don't have a single benchmark that everyone agrees on and that you can go out and passively invest in. There are a lot of challenges with benchmarking. And there are times when reasonable people will disagree on how to benchmark an asset class. So what we tried to do in working with staff is to have some consistent philosophy, and I'll go into that in a minute, behind the benchmarks. So there's a reason why, when there's some ambiguity as to the benchmark, that we chose the direction we did. So I'll go into that as well. I will underscore that benchmarks are far from perfect. Some asset classes, especially liquid asset classes, over shorter periods, any benchmark is going to be misleading. So I think it's always important to understand the shortcomings of benchmarks as well when you're looking at the context for the fund. So what we're really looking at here are two kind of issues. What are you attempting to measure with the manager? Is it that the manager has been successful within its asset class, or are you looking at this asset class relative to other opportunity sets that we maybe could have used? For example, when someone's looking at benchmarking private equity and they use, for example, the public stock markets plus 3%, they're saying, I could have invested in the public markets. Instead, I'm locking up my assets. I expect some extra return from that. That is what we might call an opportunity cost benchmark, that you have something else there. In hedge funds, sometimes people will use a public markets return, such as maybe LIBOR plus 3, or maybe something even as aggressive as we've recommended here, a stock and bond mix, to say I could have gone out and invested in these instead, and I chose to invest in hedge funds. I'm going to set this hurdle relatively high to make sure it's really earning its keep. So we've made some choices like that we'll go into, and I think actually we've made, in some cases, the benchmarks even more aggressive than they were in the past. In some of these areas also, we're going to be needing to give a secondary benchmark over time. So for example, what I just described in hedge funds, if we use that opportunity cost concept of stocks and bonds as being where we could have invested instead of hedge funds, and that's our primary benchmark, we also want to see if the manager is effective within its own category of hedge funds. So what we'll be doing going forward is once a year coming back to you with manager-specific kind of secondary benchmarks and doing some evaluation, a little deeper dive to really look at the effectiveness of the various managers and the implementation over time. Okay, does that make sense to everyone, or do you have any questions on that? It may be more obvious when I get to the actual benchmarks.
Just one question. When you
Yes.
do that benchmark and answer the question of, whether you would have just invested it in a passive portfolio. Will you also identify what additional risk you took on?
Absolutely.
And not just volatility risk, but the risk, whether it's credit risk or other risk, not just volatility.
Yeah, it's an excellent point, and it's a real shortcoming of a lot of benchmarking is that it tends to be on a return-only basis. You're really not looking at the volatility. You're not looking at the downside. You're not looking necessarily at VAR, for example, value at risk. Leverage, illiquidity can be considered a risk, headline. I mean, the list of risks is a long one, so it's difficult to have any single metric that gives you everything. But I think it's essential, and probably not every quarter, but once a year to maybe do a deeper dive on each of these asset classes. What are these other risks, and are we being compensated for it? So I agree completely. It isn't a simple exercise, but one that we should continue to kind of challenge ourselves as to what's the best way to look at these risks and whether we're getting compensated sufficiently for it or not. So this is what we're recommending. So let me go through this. There's 2 pages of these. They're not as bad as they look, and I'm going to dig into some of them a little bit more deeply, but it's a relatively short presentation. So global equity and global equity portable alpha, we're looking at the same benchmark here, and we are looking at a change in benchmark. So we were using the All Country World Index, which is a pretty broad representation of U.S., non-U.S., and emerging markets stocks. What we're suggesting changing to is the All Country World Investable. It actually goes a little deeper, incorporates more small cap stocks. I'll show you a chart on it in just a minute. But we see it as a more comprehensive benchmark, and that's why we're recommending the change.
I'm not quite sure what the difference is between the World Index and the investable market
Yes,
index.
a little more small cap, and I'll go into it in just a second if you'll bear with me, because I've got an actual chart on it. Well, you know what? Let's just go to that and we'll come back. So this is the change here. So if you maybe start, if you will, over on the right instead of the left. So let's start out with that global standard index. That's kind of what you have right now. That is that yellow bar. And it's about 85% overall of every possible stock you can find in the global stock world, emerging markets, U.S., non-U.S., okay? And it's been kind of the standard that a lot of people use when they're looking at their broad equity opportunity set. But as you can see, there's a whole bunch that are excluded. This global small cap index exists out there. That's another 15% that you're not currently including in your benchmarking. We thought it was appropriate to move to a more comprehensive benchmark. So what we're actually recommending is moving over to here, which represents about 99% of the overall global stock market. And the only reason these are excluded is they're just so tiny that they don't have enough investment potential. This is how this is being characterized by MSCI. So it includes virtually everything that one could invest in on a cap-weighted basis. So that's what we're recommending moving to, and we think that's a better, more comprehensive representation of the market set. Does that address your question on the differences? Okay. Any other questions on that, or shall I go ahead? All right, so one of the areas that we already talked about, and we'll be talking about more a little bit later today, are equity option strategies. That's a newer category within our lineup. And we are recommending this CBOE Buy Right Index. So it's basically a quantitative derivation of what equity option strategies are doing. So basically a passive implementation, if you will, of this strategy. So we think that's a good categorization of what is trying to be accomplished there and is really the benchmark that is primarily used in that space. We're recommending no change in the private equity benchmark, no change in the cash or the aggregate benchmark. We are implementing portable alpha for the U.S. aggregate. Or that latitude is being granted. You aren't necessarily going to utilize it, but that's something we can do. It would be measured against the same benchmark as the aggregate bond, as the broad U.S. bond component. I do want to point out that for both of the portable alpha strategies, that would fall into the camp of once a year we want to dig in a little bit further and say, you know, back to your point, Peggy, we've taken a little bit additional risk here in doing portable alpha on top of an underlying index exposure. Did we earn our keep in doing that? So we'll be doing a little deeper dive on that annually to make sure that those underlying managers are doing well. One area another area we're recommending a change is in mixed credit, and Jeff referred to this earlier. For a long time, your mixed credit benchmark has been evenly split between three different indices, kind of representing the types of things that you were utilizing in that component. So leveraged loans, high yield, and mortgage-backed securities. As we discussed earlier, that mortgage opportunity is really kind of gone down to perhaps not zero, but not a whole lot off of that since the financial crisis. After the financial crisis, there were a lot of really interesting mortgage-based kind of credit opportunities out there that's largely evaporated. So we're suggesting that the benchmark be switched to just representing a more
Corporate credit.
typical mix of corporate credit instead of the mortgage back.
As I recall from some of our manager approvals, though, they're trading ABS. Right?
Yeah,
Shouldn't we
there's-
have ABS in there?
There's
Right?
some structured credit, and, well, part of this is, we need to revisit whether or not that's, how much there is, and is it really compelling enough that we're better off with that than, because we set up some of those to tailor them to the benchmark
Yeah.
that existed.
Mhm.
So we'll need to, go back through the portfolio and, ask the question. It certainly is not a third of what we're doing by any stretch of the imagination. But that's a absolutely fair question. It's just part of the work we need to do ahead of, July 1 implementation.
And for example, if going forward, we find that there are different types of managers being included in some of these asset classes that are not reflected in the benchmark, then I think it is actually appropriate for us to come back to this group and add that. If it's a small allocation within the component, I wouldn't see the need to do that, but if it was something that was a meaningful component, we would definitely come back and recommend change. Okay? Yes. Absolutely.
In regards to private equity, I know it says fixed policy, the current benchmark is the fixed policy weight, which, and it's my understanding that by taking off the targets, we're benchmarking private equity based on the amount that we actually have, not based on, so if we have 8% private equity, rather than 9% as we, challenge our convictions and try to develop more conviction with the managers, and if the amount of private equity comes down, then we're really judged on just what we have, not a fixed target weight as we were before.
Yes, and I can see how that might be. So when we're saying fixed policy as a weighted blended benchmark, what we meant was fixed is that 80-20, not the target allocation to private equity. But I'm glad you pointed that out because that could be misconstrued. So here we are looking at a more global, but not as non-U.S. oriented as you are within the U.S. Within the global equity component. Let me restate that so I'm not confusing everyone in the room. In the global equity space, so when you're talking about long-only stocks, it's roughly 50-50 U.S., non-U.S. It depends on what period you're looking at. Sometimes it's more non-U.S., as it's been lately. Private equity, you'll notice, is 80% Russell 3000, which is a U.S. stock benchmark. And one might say, why don't we use that global benchmark for private equity? The fact of the matter is you don't have as much of a global exposure. Really no one, very few plans do. Most are dominated by U.S.-centric private equity investments. So that's the reason we have a difference between those two weightings. But we just wanted to be clear what those weightings were. Other questions on this page?
Quickly, on the
Absolutely.
equity option strategies, you mentioned that the CBOE is the passive benchmark, or benchmark for passive activity.
Right.
And then at the U.S. aggregate, you had Barclays Aggregate Bond Index, no change. Well, both of those are what we should get without doing anything, correct? I mean,
Correct.
So aren't we picking up risk for the strategy that we're not being paid for? I mean, if we're going to own bonds and we're getting the Barclays Aggregate Bond Index, which I think is already.
Right.
Now we have a trading strategy on top of that.
Yeah, it's an interest. So on the trading strategy, we're definitely going to be looking at dissecting those managers, just as we will be with the portable alpha managers once a year to just kind of look at risk different ways. Are they earning their keep, et cetera? And I know staff's going to be doing that on an ongoing basis regardless, but I wanted to share it with the commission as well on an annual basis. But I think it's true really of any active manager. They're always going to be taking some form of risk in order to add value. The question is, how do you measure that risk and are they earning their keep in excess of it? When it's a structural manager such as the portable alpha, there's more mathematical ways that we can measure some of those forms of risk.
But as it sits now, they could be very active and they could break even, get paid a fee.
It's all net of fees.
Yeah, or net of fee. Well,
It's all
still,
net of
we're
fees.
paying them to break even in something that we would get normally anyway.
And we wouldn't consider that satisfying. So just a manager hitting their benchmark is not gonna be satisfying to anyone in the active space.
So should we have that reflected in the benchmark?
We're not huge fans of thresholds unless there's a really good reason behind this threshold. And we did talk about a couple of ways to create some harder thresholds on a couple of these to add more, and it gets really complex really fast. And we said, let's keep it simple in terms of opportunity cost.
But even if it was just 1 basis point, because if they just matched what we would already get, why would we be involved with it at all? I mean, we have to commit staff to it, and of course, there's always risk.
Right.
Well, that's any strategy.
Any
Yeah.
strategy,
Right, yeah.
no matter
Any
what
at
the
all.
manager
But
is
it's not
doing.
specific to any
That's right,
one
but
line
what we
item.
have here is, you know, I mean, we use the Barclays aggregate bond index and,
Right.
and meet it all the time, even surpass it. So if we're saying we're gonna pick up an active strategy to beat what we should get anyway, right? I mean, we should be able to meet the,
That's the only reason to be active,
yeah.
right?
Right.
is-
So, but how do
is
we
to do
measure
better.
that? That's, well, only point I'm trying to make is, if they return net of fees the exact same thing that we should get anyway, we still have beaten our benchmark.
No.
No, you
Or
would
met our,
match.
we met our benchmark.
You would match, but we
That's
don't
why if you had,
consider
if you
that.
had 1 basis point more, you would be able to quantify
Yeah,
that.
you took a
you
long
lost.
walk around
That's
the
right.
block.
That you had all this risk, but you didn't make it.
Absolutely.
I won't belabor the point.
I see your point.
It's active
Um,
risk, right?
and-
Yeah, you chose to try to do better and it didn't work, right? That's the risk there.
I think the other consideration there is there's different levels of active strategies in the space. There's some that are gonna target a different return potential. So you'll hear later, one of the managers targets somewhere between 200 and 500 basis points above that benchmark. So that's a good way to measure success for that individual manager is, are they meeting their performance objective? But just like any other asset class, there's different levels of active management, so.
But we are gonna be right back where we were, have a very low benchmark, and take on risk, and it not be reflected in the benchmark.
I don't think this is gonna be a very low benchmark, but I think what you're suggesting is something we're gonna be doing in a couple of different venues. So one is, we're talking here about the total fund benchmark. We have to come up with a combination of all these different asset classes, pull them together to reflect what you could have passively perhaps earned without taking all of this risk. So that's what the policy portfolio to us represents. However, we're not holding that as the only metric of success. The managers themselves have to earn their keep, and there are harder benchmarks in some cases for some of these underlying managers, or different benchmarks dependent on what they're doing.
Thank you.
So it has to all roll up together. I know there's a lot of moving pieces here. It's, we had a lot of discussion about the best way to be approaching this. Second page, so on emerging market debt and private debt, we've not recommended any change. As a reminder, your emerging market debt is split between local and US dollar terms. By the way, at the end of this presentation, there is a glossary of all of these indices. I know that it's hard to keep in your head all the different things that we have going on. I'm happy to discuss any of them if you'd like. On the private debt side, just to kind of note the consistency between how we're benchmarking private equity and private debt, we're looking at a marketable index plus a threshold to represent that illiquidity and excess performance that would be expected. On the GTAA managers, or the global asset allocation managers, the only change here, as you can see, we had a 50-50 benchmark between the world index and the government bond index. In both cases, we're going to a broader benchmark. We already discussed the MSCI Investable World Index, so including that small cap piece that had not been included. The aggregate, rather than the World Government Bond Index, is more representative of the broad credit risk as well as government securities, but it is a US-based index. I'm sorry?
Can I ask you a question?
Yeah.
You're on the GAA when you get to the hedge fund one.
That's where I was going next, so
Right.
jump on in.
Right, I mean, unless they're macro, right? I mean, aggregate bonds are all investment grade, right? That's not what hedge funds trade,
Right.
right?
Right. So one of the things we're doing here, so it's an excellent point. So here we've got what we're calling an opportunity cost benchmark. So there's two things going on in the hedge fund portfolio. As you think of your hedge fund portfolio currently, it's largely all together in one place. Now we're looking at using the low beta strategies in the portable alpha overlays. So the managers really don't have any exposures or going there if they're good. In some cases, you may not choose to use them at all. What we wanted to do was set a relatively high opportunity cost benchmark in the hedge fund area. So those managers together have to earn their keep. So I'm with you completely. This is not going to be representative of what the managers are investing in necessarily, but it's rather saying this is the hurdle we place on this dedicated component.
In classical benchmarking, this is a violation of that,
Yes.
right? But this is seeking to force us to say, we are going to invest in hedge funds because we see a better solution than investing in markets. That's, yeah.
Then be our asset allocation, not that way.
Well, we have actually we talked about hedge funds, portable alpha in both the areas. It's being things that you only invest in when you have conviction. So we are anticipating that the default is zero. So you have to have a threshold here to have belief and confidence in
but
this
You mean
manager.
put the
Threshold with
weight
the
in
rest of
GAA?
No,
Is that what you
so
mean?
like the hedge fund, right, opportunity cost, right, that would be your capital, right, kind of like a capital cost.
Yes.
Yep.
Which should be our asset allocation, because that's
Oh,
effectively.
the rest,
Oh,
we
you mean
talked, we
the
actually
rest of
talked
the
about
plan.
that.
Yeah.
Yeah, we talked about that. What we decided to do instead is keep, so GAA, hedge funds, and opportunistic strategies are all in the same component. And we decided to just keep a single benchmark set among the three to really use that as our threshold for success in that space. And that's how it was modeled. So we went back and modeled it that way as well to make sure that it made sense.
The muffled screams are coming from our reporting team. Hearing that, but yeah, I mean, that's
We did
absolutely,
discuss that as well.
I would say the liquid part of your portfolio,
Yeah.
you know, because I don't think you would necessarily make the decision to be illiquid
Yeah.
if it's supposed to be a dynamic portfolio, but I get your point.
And this is a classic space where we kind of have this opportunity cost benchmark to look at it as, hey, we're not just trying to fill a bucket. We're only going to utilize these things when we see them as truly adding value to the overall total fund. But that means that everything underneath it, we have to do some additional evaluation and reporting on. So that's exactly the type of thing. So for example, in the hedge fund space, let's say you have an equity long short manager in there. We're going to want to be doing some additional analysis and reporting about how that manager is done against those benchmarks as well. But at the total fund level, this is what we're holding that component to. So it's actually a more challenging benchmark than what we've been utilizing historically for hedge funds.
And the goal, and it's for your consideration as to whether or not it is a reasonable attempt at that goal, is to force that decision, instead of saying every bit of hedge funds I get is a gift from above, you know, this forces that we have to get the decision to use hedge funds somehow pushed into you know, your decision tree gets pushed in there. Otherwise, it needs to be decided at a very high level, you know, at the highest of high levels in asset allocation. Yes, hedge funds are, you know, going to be great. And, you know, when I look at the benchmark returns for hedge funds, it's, you know, it's getting harder and harder
Right.
these days because it's a terrible benchmark, right? So there's no great way to arrive at this. This is my desire to force some, you know, kind of conflict into the portfolio and some disagreement into the portfolio about, are we better off with an alpha stream or the beta? You know, forces you to have a view on the beta in order to, you know, set your portfolio. So it may or may not be to the liking of the commission, but it's trying to think differently about this.
Yeah.
No,
So,
I think it's
yeah.
the right thing. I mean, I had this conversation with Herschel, right? I mean, it's kind of like a weighted average cost of capital,
Yeah.
right?
Yep.
Yeah.
But it's
Good way
not
to
our
look at it.
cost of capital, because that may or may not.
Yeah.
I don't know how 50/50 tracks against our portfolio. They may be close, they may not. I suspect they're probably close, but.
Well, so
Right. Right.
Plus high yield and commodities, so, you know,
Right.
probably coincidentally winds up being reasonable.
Right.
there is a
I
challenge.
get your point, and that's an interesting, because, you know, that is your opportunity cost.
There's a challenge here. Anytime you use an opportunity cost benchmark, it's not going to track as closely. So on a quarter-by-quarter basis, you should anticipate more tracking errors. So I just asked the commission, we'll be saying that more than once probably in the next year, just to remind everyone that some of these benchmarks are intended to be a little bit longer term in perspective. So someone may look brilliant or stupid in a quarter-by-quarter basis. Let's dig down and really understand what's behind that. So that's one of the reasons we want to do that additional reporting for you. Just to tie things up, REITs are a new component within the real estate asset class. It is a liquid, publicly traded security index out there. The NAREIT index is used by virtually everyone in the real estate area.
Question there?
Absolutely.
MSCI is now attaching that as the 11th sector effective September to your just equities, right? Why don't you just shove it all into the equity bucket?
Yep. And some equity managers will make use of REITs. It's not a forbidden sector to use.
I mean, it's going to be a big front run, right? Because all the generalist funds are going to have to buy REITs between now and September to get to benchmark weight, because it's going to come in at like 11%.
Yeah,
It's going to be a big number.
that's good. We'll be in there by then.
That's fair, that's a fair point, certainly. The use of REITs in our portfolio is, you know, to allow us to target that kind of real estate level. So, you know, we cluster it that way. So, I mean, I don't know how you have the sufficient optics to see what we're doing, if it just is part of the 35% equity, you know, I don't know if that
I just
necessarily
say,
shows
we're going to have
you.
some generalist
Yeah.
funds that don't own REITs that are going to be buying REITs.
Yes.
Right? Like, we have an index fund right now. Now, some of it's going to be reclassed, right, because they might be embedded in financials right now. But, I mean, this is an index construction issue, right, that we ought to be having with our index providers, right? Because with a dedicated exposure on top of what they may be having to do, right? Yeah, I mean, you're going to see some real.
Yeah, it was
movements.
$100 billion.
Huh?
$100 billion flows coming.
Yeah.
Yeah.
You know,
So
number of-
like our index funds, like I said, some of it may be reclassed, so it wouldn't have an effect, but if, to the extent that it's not a reclass of a REIT, right, then they're gonna be loading up, and, you know, we're essentially doubling up the bet. And I can tell you, the hedge fund community's definitely trying to front run this trade. It's
Sure.
a big trade.
Absolutely.
Right?
Well, we've already have some allocation, so it's a helpful thing. Yeah, it's a good question. We are looking to have a liquid and an illiquid component kind of coupled together. So we have that in private equity, we've got it in private debt. This was the attempt to do that in real estate. We'll be talking about infrastructure in a second. So it provides some liquidity and some ways to get some more agile exposure to the asset class rather than waiting to have it drawn down over the course of years. So you're not anticipating necessarily having a huge allocation to REITs over time. This is a very modest allocation that we're looking at. So I'm not terribly troubled by it, but I hear what you're saying. That is something that's going to be creeping into all elements of our asset allocation because of these changes. Agreed. We're not recommending any changes in the real estate benchmark that is private real estate. So just as a reminder, that's kind of a core open-end index, but we're adding 75 basis points on top of that to reflect that you're also investing in closed-end funds that take a little bit more leverage, a little bit more aggressive position, and should be expected to earn a higher return over time. So that's reflective of the mix that you have between core and non-core private real estate. Infrastructure is a new asset class. We are looking actually to discuss it today. So that is the initial investment is anticipated to be only in liquid securities. So we're using a liquid securities index, the Dow Jones Brookfield Infrastructure Index. So that's reflective of largely stocks, but stocks that are in the infrastructure component. So that is, again, one of those where there's some overlap between what you're doing in your stock component and here. But also it's a way to be getting a bit of exposure to equities across a range of asset classes as well.
And I don't want to go too far to the investment we're going to talk about, but as I looked at that, it's equities, commodities, because certain of these infrastructures are completely around commodity, like pipelines and things like that. Is it really an infrastructure class, or is it just equities?
I can see Ashley's dying to say something.
Yeah.
Would you?
Can we table that?
Yes.
We're going to talk about.
I didn't want to talk about it later on. I got a headache last
So
night.
there's a
won't
lot
be
of great
long.
stuff that we're doing there.
Yeah.
So and I would point out that we're also looking long term to be investing in private infrastructure, which is a very different animal as well. So, but the initial allocation there was in the liquid space. So that's why we're just dealing with the liquid component right now. I will tell you there's not an easy way to benchmark illiquid infrastructure, so that's a challenging one as well. So I think we've touched on all of these. This is just kind of dealing with the change on the existing benchmark and fleshing that out in the bond area. We already discussed that. And then what we discussed in the GAA area and hedge funds. So I think this summarizes everything we've already discussed. As I mentioned, we do have these brief definitions back here. If anyone is going, what is that Russell 3000 again? Because some of them aren't as intuitive as it might seem. So just in the interest of time, I was going to end there, but are there any other questions, discussions? I'll kind of go back to the summary here in case people had those.
Further for Suzanne?
So just as a reminder, send me questions if there's something that doesn't hit you right, or you don't understand, or why are we doing it this way instead of this way. I'm happy to address any of those questions, and we can figure out if there's any needed changes for the June meeting before we ask for adoption.
Thank you.
Thanks.
All right.
Mr. Chairman, that concludes my
All right, do we have to move on to these investment recommendations?
You want to, we
Yeah,
have on
take
the
it.
schedule, we would have like a short break.
You
You
wanna
want to take
take-
a very short break?
Want
and
to
then-
take a
and then
10-minute break or
maybe-
5-minute break?
Yeah, and then maybe we'll come back, hear one of the investment recommendations, and then break for lunch.
All right, why don't we take a 10-minute break, 5-minute break? All right, let's take a 10-minute break. We'll reconvene here in
Yes.
11:40.
We'll try to be,
I think we can reconvene. Let's come back to order. All right, Jeff, you want to take over?
Sure. Thank you, Mr. Chairman. If you recall, back in the first wave of challenging beliefs, one of the issues that we discussed at great length internally was the amount of equity in our plan. And we sort of arrived at this understanding that we all like equity in a very long-term sense, but the current market environment valuation, it makes it difficult for us to make a very simple move into equity. And why does that matter? That is the single most important explanatory factor when you look at our performance against other plans. It is a profound underweight versus other plans. Not that this is what drives our thinking, but it is important to have an awareness of this. The amount of equity, specifically U.S. equity, in our plan being, think of it in the neighborhood of 15% below that of our peers. We understand why people have equity. It's a great long-term performing asset, but we're just not excited to take full equity risk in a marginal way right now. So that brought us to thinking about if equity markets are elevated from a valuation perspective, how do we think we can invest in equities if we are in a sideways or maybe slightly negative market environment over the course of the next several years? How do we add an asset to the portfolio that we think can actually perform in that type of environment? So we landed our thinking on these equity option strategies, which we've reviewed before, and I don't want to go too long in my wind-up here. So, the asset allocation we approved in February did include a 5% allocation to equity option strategies, by which we mean covered calls, put selling, the basics. And over the past 20 years, these types of investments have performed very similarly to the S&P 500 with about 2/3 of the volatility of the S&P 500. So Justin Young, who is nearby,
There,
Right
left.
over here.
hidden from me, and Steve Marino have evaluated a truly dizzying array of investment strategies. And beyond that, they've committed themselves to developing a very technical understanding of how these strategies work, the benchmarks, et cetera, et cetera. Alan, I think at a prior meeting, you pointed out that the benchmarks are rules-based, but they are not the model for how you implement, right? So what they did was they went out and they approached it from, asking a lot of different firms, how do I improve on the benchmark in order to implement this? So they've studied white papers. I find myself genuinely impressed with both the breadth and the depth of their understanding. They've passed me by. I'm actually proud to say they've passed my understanding by. That said, I asked them to try to keep the presentation brief. It would be very easy for them to wind up giving you a NASA level briefing on this, but I've asked them to keep it, between the ditches for most of us here. So if you do have a question, even if it's a technical question, I know they'll be happy to answer it, but with that said, I just want to turn it over to Steve, who's going to walk us through two strategies that are kind of the first wave of what we're looking at here. And Steve, I hope I've not harmed you in any way during the setup, so.
Yep, so thanks, Jeff. As Jeff mentioned, we're recommending two managers in this recommendation today. Would like to thank Justin for his help in partnering in this search with me. In addition, Aon Hewitt provided a dedicated resource in this search. So early on, thank you. We evaluated 10 managers back starting in January and are at the two managers that we are recommending today. So thank you for the help with that. Throughout the presentation, I'll briefly review the case for equity options that we reviewed in November commission meeting and the objectives of the search, as well as then change gears into discuss the Russell as well as AQR manager recommendations. As echoing Jeff's comments, this allocation resulted out of the challenging beliefs where we need more equity-like returns but can't really accept the full equity market downside exposure. We believe the BXM index or covered call strategies can get us there, but that we can implement this in a better way to improve the experience that we can expect moving forward, specifically leaning on enhancing down market participation and then generating excess returns through a full market cycle. Take a quick step back and just look at the profile of investing in a long stock. If you buy a stock at $10, it goes up to 11, you make a $1 profit. It's fairly simple. When you throw on a covered call strategy, the profile ends up changing. In this example, the blue line is the covered call strategy profile. A covered call is essentially a long position in a stock and then selling a call option. So you receive a premium today in exchange for selling away the upside of the market. So in rising markets, you'd likely underperform the S&P, but in downward trending markets, you're benefited by the premium that you receive from selling the option. This is a very similar profile as well to a put, where you sell a put option and then hold cash. The BXM index does this structure on a monthly basis on the third Friday of every month. So as we mentioned, selling the upside caps your upside participation, but benefits you on the downside. Would also like to highlight that in trending markets, however, you end up having an asymmetric type of profile where your upside is limited to the premium that you collect. However, you do wear the entire downside of the market less that one premium. And so two ways that we believe that we can improve on this is one, by selling options more frequently, so selling them on a weekly basis in the case of Russell, or maintaining a consistent equity market exposure, which is the case with AQR, which hopefully puts you more into the distribution of the center of this structure, which helps to increase the profitability and smooth the return experience. This chart illustrates three various market environments, and I think is a great way to frame the expectations that we should have with these strategies going forward. First being the financial crisis, which would be peak to trough. Calendar year 2011, which is a sideways market. And then 2013, which is a bull market, S&P up 27%. So in the financial crisis, the S&P was down 52% peak to trough, whereas the BXM was down 36%. So significant risk reduction on the drawdown experience just by picking this benchmark. But the proposed implementation can improve upon that, outperforming by approximately 10% through that time period. In a sideways market, S&P was about 1%, because we were selling the option premium, we're receiving income today in exchange for the upside optionality in the market. The BXM and the proposed strategy would likely outperform the broad equity market at the expense of underperforming in a substantially up or rising equity market, in this case, S&P up 27%, still participate in the market, but about half of the experience. Just kind of bring it back to the payoff profile that we had on the prior slide. I hope thinks it ties it all together a little bit, but in the down market, outperformance, sideways market, outperform, and in an up market, underperform. So with that, if there are not any questions here, I can move directly into the investment manager recommendations. Okay. So we're going to make two recommendations today. The first is Russell's enhanced put right strategy. This is a systematic enhanced put right strategy, sells puts instead of sells calls like the BXM. The goal is to minimize unintentional risks from strike date selection, in particular the third Friday of every month, and to generate 200 basis points of excess returns with improved downside characteristics. We're recommending this based on 4 key attributes. The first being that these systematic enhancements by selling monthly call or monthly put options on a weekly basis help to smooth out the volatility as well as the downside participation in the market. In addition, sell options with longer tenors, so a 2-month option as opposed to 1-month option. This as well creates a more defensive profile. In selling a more diversified set of strikes or of options helps to generate additional returns through diversification, essentially monetizing intermittent or intra-month bouts of volatility by selling options at now a higher price. We believe Russell has a robust execution platform, managed $72 billion in derivative overlay assets, $5 billion in option-related strategies, supported by 24 portfolio managers and traders. And lastly, this is a very cost-efficient implementation at 15 basis points on a blended basis on an initial $600 million investment. There's a few slides that I'd like to highlight, or a few key points I'd like to highlight on this slide. The first being the total return experience of this over the 10-year period. On an annualized basis, 7.7% or 270 basis points in excess return versus the CBOE BXM index, as well as the S&P. It does so with a lower level of volatility, 9.5 versus 14.6 of the S&P. But most importantly, it's the down market participation of down 27% in the financial crisis versus 36% of the BXM and 52% of the S&P, so roughly half of the down market experience. Notice that in this chart above, but also that over the cumulative experience in the 10 years, outperforming both S&P and BXM from the enhancements. So while the systematic enhancements can over time add value from the structure, these can also detract in shorter time periods, so in a month or 2-month basis. But over time, we do believe that the defensive nature should benefit the strategy in the long term. Additionally, Russell is owned by 2 private equity firms, TA Associates, as well as Reverence Capital Partners. Likely, there will be a future sale, we just don't know when. But having a separately managed account structure with its own separate IMA helps to mitigate this risk and allow us to transition out of the manager and replace the manager if we don't believe that they're capable of running this strategy in the future. So that recommending up to 3% of plan assets into Russell's enhanced put right strategy. This be a separately managed account, separate investment management agreement from the current overlay contract. The custodian's Bank of New York Mellon, and it's 15 basis points blended fee on $600 million allocation, and the tiered structure is here for your review.
In addition to the fee, is there any additional costs related to trading expenses?
So normal custody costs as well as transaction costs will be borne by, again, the cost of the assets. And so that's typical of any in-bank asset that we have, but no additional, I guess, fund level expenses or anything like that. Okay. Move on to AQR and then take questions at the end. So the second is AQR Aero Composite Strategy. This is 2 investments into 2 different commingled vehicles, the AQR Style Premia US Equity and the AQR Volatility Risk Premium account. These will be governed by a master investment management agreement, which will govern the relationship between the two, specifically the rebalancing across these two funds. The goal is to minimize the unintentional shifting equity market exposure that's inherent in the BXM index, but also to sell options intelligently across various markets with a specific focus on tail risk management. We believe there's 4 key attributes that helped us form our opinion of this manager and the recommendation. The improvements of the BXM index are primarily through structural enhancements, this being targeting a consistent 55% equity exposure. So what this allows the strategy to do is outperform in up markets and outperform in down markets. It does so by maintaining more equity exposure when markets are rallying and less equity exposure when markets are selling off. In addition, there's diversification across strike date, option maturity, and the level of strikes that are, or the moneyness at which they're sold. We believe this will enhance the premium collection through market diversification as well by selling options outside of the U.S. markets. This is a risk reducer. It reduces one-day market shock risk specifically to U.S. markets in the event that there's a 20% drawdown, heaven forbid, in one day in the U.S. markets. Historically, those events have not been as correlated outside of the United States. The BXM sells options only in U.S. markets, so you get diversification across geographies. The 55% equity allocation will be actively managed. It's leveraging AQR's proprietary stock selection models across value, defensive, and momentum strategies to achieve excess returns. And lastly, they have a deep, seasoned team with a research-driven firm. They take academic research, turn it into fundamental investment ideas, and into implementable, actionable portfolio construction process. We're supported by 52-person stock selection team and 6 people on the volatility side. So similar to Russell, there's 3 key attributes I'd like to point out on the results. One being 250 basis points of outperformance over the S&P and the BXM over a 10-year period, with 8.7% volatility versus 14% of the S&P. The drawdown experience is improved over Russell, 25% versus 52% in the S&P. And also would like to highlight the down market beta to the S&P at being 0.55. This is effectively the relationship between $1 move down in the S&P. You could expect 55 cents move down in this strategy. And this 55 is very similar to the 55% equity allocation that they're holding on a constant basis, illustrating the market neutral or lack of equity exposure in the volatility component of this strategy. So there's 3 considerations we would like to highlight and address. The first being that while active management within the equity portfolio has added about 100 to 200 basis points over the course of this track record, this could underperform and this could be to the detriment of the strategy. However, have comfort with us knowing that the excess returns from the stock selection piece have a very low correlation with the volatility risk premium component. And in doing so, they're very complementary, and the package of the two helps to achieve better diversification and a better product over the long term. In addition, because of the way that the portfolio is structured, this will likely underperform the BXM in a sideways market. This is due to the benefits that it has in a trending up and trending down market. I think it's also important to note that this is very complementary to Russell's strategy, and Russell's strategy should outperform in periods of sideways markets. And so as a package, it's better than any one individual. And lastly, AQR manager concentration. We have a 4% allocation to Global Enhanced Equity Manager or equity strategy with AQR. Adding an additional 3% will get this firm level concentration to 7%. We'll continue to monitor any fund flows, investor composition, changing in staffing levels at AQR. But we were able to leverage the current relationship size to help achieve better fee economics. So with this, recommending up to 3% of plan assets into AQR Aero Composite Strategy into 2 commingled vehicles, the AQR Style Premia U.S. Equity and the AQR Volatility Risk Premium Account. There'll be a separate investment management agreement that will govern the rebalancing between the two, as well as the relationship between these 2 vehicles. The custodian is State Street, 45 basis points on a blended $600 million allocation. And note that there's a 10 basis points cap of operating expenses at the commingled fund level. So with that, I will pause and take any questions that you guys may have.
Do you worry about wringing too much volatility, hence returns out of this? You know, we did this with much complicated, more complicated and expensive structures, and this is straightforward and it's a lot lower fees. But do you ever worry about that? I mean, at the end of the day, we talk about a 100-year plan and all that we worry too much about that volatility, and therefore we give up too much return.
Yeah, I think this gives us a good lever to pull in the sense that from a strategic standpoint, if we put the money in here over a long term, it should be equity-like in its returns, but there'll be periods of underperformance and periods of outperformance. But from a tactical perspective, thinking 2 to 3 years out, if you were to ask, do you think equity markets will be up 25% next year? I would be hard pressed to see anybody raise their hand about that. And so where we are in the cycle, this provides, we think, a better probability of having better returns in kind of a sideways to low returning environment as well as a down market. But to that point too, if we do have a series of down markets, this should at least provide a cushion that will then enable us to make that tactical rotation back into traditional equity strategies. So.
I think Jeff and I, we've all kind of talked about this a bit. I mean, I think one of the things that happens, back to your ability to maintain it, like a flat year, right? And now we've been flat for what, 2 years roughly, almost in S&P, right? 2 years, ever since QE ended, right? Market quit going up. But you're losing actuarially, right? Which creates all the budget issues, right? Because if you don't make 7.5, right? So if a big chunk of your equity is not making anything between 0 and 7.5, that still creates budget pressures, right? So I think having stuff that works, if you know, just in that muddling environment is important too, right? Because just the way the accounting works, you know, on a plan, right? Because otherwise you would make that up to a funding thing, but I mean, is that really going to happen, right? Like if you said, okay, you know, we're going to shortfall for X number of years, right? I mean, there've been 16-year periods where equities don't do anything. Right. So for 16 years, if I don't make 7.5 on 40% of my portfolio, am I willing to fund it? Yeah, I question that. Right.
You can go on to the Deutsche.
Well, we would need to, we have two.
Do you want to read the Russell
Yes, sir.
motion?
We have motions in regards to each of these strategies. Mr. Chairman, I can read, we can take them one at a time if that's the desire of the commission. The first would be in regards to the Russell Implementation Services, Inc. Adopt the recommendation of the acting CIO and the Internal Investment Committee as set forth in the summary chart on page 1 of the due diligence report dated April 21st, 2016. Authorize an investment up to 3% of total plan assets into the Russell Enhanced Put Right Strategy through the use of a separately managed account agreement. C, authorize the chairman or designee to negotiate and execute any necessary documents to implement the investment as approved by the commission. 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3-day business review period as approved by the commission on May 1st, 2014, or as a review period may be amended or superseded by the commission. And D, authorize the chairman or the acting CIO or the designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the retirement system trust funds obligations with respect to the investment.
Motion to approve? Second? Any discussion? If not, all those in favor of the motion signify by saying aye. Aye. Opposed?
It's unanimous.
No opposed, so, okay, so motion is carried.
Mr. Chairman, the next motion would be in regards to AQR capital management. A would be adopt the recommendation of the acting CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated April 21st, 2016. B, authorize an investment up to 3% of total plan assets into the AQR Aero Composite Strategy governed by an investment management agreement. The strategy will invest in and rebalance between 2 commingled funds, the AQR Equity Style Premia U.S. Equity Beta Master Account LP and the AQR Volatility Risk Premium Master Account LP. C, authorize the chairman or his designee to negotiate and execute any necessary documents to implement the investment as approved by the commission. 1, upon documented approval for legal sufficiency by RSIC Legal. And 2, upon expiration of 3 business day review period as approved by the commission on May 1st, 2014. D, authorize the chairman and/or the acting CIO or their designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the retirement system trust funds obligations with respect to the investment.
Motion to approve. Second?
Second.
Any discussion? Hearing none, all those in favor signify by saying aye. Aye. Opposed? No opposed, motion's carried.
The Reynolds vote on that one. The Reynolds vote on that.
Oh, Reynolds, I'm sorry, did we hear you voting on that?
You may have dropped off.
You may
I
have
don't know
dropped.
if you heard me or not, but I did vote.
Oh, okay, very well. Okay.
Which way?
So it's unanimous.
All right, so now we're going to move on to that Deutsche Global.
Thank you, Mr. Chairman. The asset allocation adopted in February includes an eventual 3% allocation to infrastructure phased in at 1% per year for 3 years. By way of backstory, late last fall, I asked Ashley Aslan to start working on an implementation plan, and I'm very happy with what I've seen come out of her in this regard. And there are several ways that we can approach infrastructure investment. What you're going to hear is a listed approach, and we determined that a listed approach provides a good foundation as we build out the infrastructure portfolio. So over time, we will certainly consider private infrastructure investments, but we do need to do more work on that area before we get there. The gradual phase-in of the infrastructure target allows us the flexibility to be thoughtful with how we approach the use of core and closed-end private funds. But what we're going to focus on today is simply the listed space. And as Ashley will demonstrate, the underlying assets that we'll be investing in have very specific characteristics that differentiate them from traditional public stocks. And this is the thesis for why do we do listed infrastructure. And I don't want to steal any of her thunder, so I'm going to let her address this. So thank you, Ashley.
So as Jeff said, today I'm going to make a recommendation for an investment into global listed infrastructure, specifically Deutsche's Global Infrastructure Strategy, Security Strategy. But before I do that, I do want to take a minute and recognize Josh Green and Kevin Matherly, who were an integral part of the search team who did this with me. So to start out, I want to provide an overview of today's recommendation. First, why listed infrastructure is a good way to start building out our infrastructure allocation, and then specifically why Deutsche is the best fit for this mandate. The team and I spent a lot of time discerning whether or not listed infrastructure behaves more like equities or more like infrastructure. I'm going to show you that while it is highly correlated to broad equity markets, listed infrastructure does behave differently and provides the diversification benefits that we're looking for in this asset class. I'm also going to show you that listed infrastructure has returns that are similar to that of the median private infrastructure fund, with the added benefits of scalability, liquidity, asset diversification, and lower fees. So the team and I looked at a lot of managers in this space, but Deutsche really stood out on several fronts. First, I'm going to discuss the importance of their focus on pure play infrastructure and how it allows us to view this investment as a complement to private infrastructure investments that we may want to make in the future. And additionally, their focus on real-time return drivers and their demonstrated ability to defensively position the portfolio has led to better risk-adjusted returns over time. I'm going to pause here for a minute and see if there are any questions. So I'm going to take just a minute to give an overview of the listed infrastructure space. It's a very diverse asset class. Generally, the assets fall into 3 broad categories: transportation, regulated utilities, and communications. And then there are a lot of different ways that we can invest in infrastructure. And here I have plotted them out in terms of risk and return, with starting on the left with senior secured debt returning 4 to 6%, all the way up through core plus and opportunistic, which could have returns greater than 10%. And as you can see by the green circle, today we're going to focus on listed infrastructure, which is right in the middle of the risk-return spectrum for infrastructure investments. And it's one of the reasons why I think it's a good place to start building out the core portion of our allocation. So today I'm making a recommendation for a $275 million investment into the Deutsche Global Infrastructure Security Strategy. This is going to be an SMA with custody at Bank of New York, and we have been able to negotiate a very favorable blended fee that will be no greater than 55 basis points. Also want to point out that the strategy has received a qualified rating from Aon Hewitt. So why Deutsche? There were several factors that I've outlined here that made Deutsche the best fit for this mandate. And the first I want to focus on is their focus on pure play infrastructure assets. I want to take a minute and describe what pure play means so that you can see why it's important to have a manager committed to only investing in pure infrastructure securities. Here we have the characteristics of infrastructure assets, and these are the characteristics that we want our infrastructure investments to have, regardless of whether they are publicly traded or whether they are in private funds. They are expensive assets, and so the high cost of the initial investment, coupled with the essential nature of their demand, means that they generally operate in a monopolistic market that has inelastic demand. This makes them fairly resilient through economic cycles, and then they are operated under long-term contracts, so they have cash flows that are stable and predictable and often tied to inflation and growth. So this is very important because these are the characteristics that make infrastructure behave differently, and it's the characteristics that we want to isolate within our listed infrastructure allocation because it's going to lead to a more defensive portfolio with lower volatility and a lower correlation to the equity markets. So this is an overview of the listed infrastructure space. At a very high level, there are about 400 to 600 publicly traded companies that own and operate infrastructure assets. This includes a lot of what we talked about earlier in the presentation. It's airports, toll roads, energy utilities, pipelines, and towers. It also includes some things that very much aren't infrastructure. Airlines, airport services, construction companies, and concrete companies, to name a few. If you think about in the communication sector, for example, Verizon Wireless is included in this infra-related, as an infra-related company. But we're looking for the pure infrastructure tower companies, such as American Tower, Crown Castle, or SBA Communications. So there is a difference there. So the infrastructure-related companies are not going to have the characteristics that we just discussed on the previous page. They're not going to be monopolies, they're not going to have inelastic demand, and they're not going to be operated under long-term contracts that are going to tie their revenues back to inflation and growth. This means that they are going to be more highly correlated to the equity markets, and they're not going to give us the diversification benefits that we're looking for. So if we go further down the pyramid, you can see that the Dow Jones Brookfield Infrastructure Index is about 95 securities, and it requires that 70% of a company's operating cash flows come from the infrastructure portion of their business. And this is the most pure of any of the listed infrastructure indices available. Deutsche matches the 70% rule in the definition that they use, which creates a portfolio of assets and with those characteristics that we are looking for. We looked at about 20 managers in this space. We met with 9 who we analyzed very closely, and this really is a key differentiator, the focus on this pure play. And it allows the manager to construct a portfolio of assets that closely replicates the investment characteristics and the returns of private infrastructure investments. So the natural question at this point is, how do listed infrastructure returns compare to private infrastructure returns? And before I dig too deeply into this slide, I do want to caveat that infrastructure is a relatively new asset class, so there's not a long-term time series of data to analyze when we're comparing how listed infrastructure returns compared to private infrastructure returns. But we were able to use a basic approach. We assumed an equal weighting for 3-year returns into a market and 3-year returns out of a market, and compared that to what we have for private infrastructure funds. And so the blue line that you see here, that is the median IRR for that's the IRR for the median private infrastructure fund. The green triangles that you see along that are the IRRs that we calculated for listed infrastructure. And so what you see is that for the time series that we have available, listed infrastructure does approximate the return of the median infrastructure, private infrastructure fund. And this marries nicely with our belief that we're only going to seek access to private markets when we think that there is an outside returns, which is another reason why I think starting here, where we can achieve median market returns with much lower fees, makes a lot of sense. So the second attribute that led us to choose Deutsche for this mandate is their focus on innovative return drivers. The team uses data. Some of it's internally generated, some of it is from external sources, and they use it in very innovative ways. They are scrubbing capacity data for airports, usage data for toll roads, and gasoline consumption data, looking for indicators on how certain assets or the sector as a whole might be changing. And each analyst on the team is responsible for monitoring at least one of these real-time return drivers for the sector that they cover. And this really gives Deutsche some useful insights into the companies and the sectors that, in which they invest. Here we have the strategy's attribution, and I'm going to highlight the period after May of 2011, which is the period of time that the current team has been in place. And this is the period of time where there has been a focus on the return drivers and the enhancements to the valuation models, which we'll discuss in just a minute. But what I want to draw your attention to is the immediate and obvious improvement in the returns that are coming from security selection, which is indicated by the dark blue bars. Also worth noting is that Deutsche is able to drive returns through both security selection and sector allocation, which is indicated by the light blue bars, which does give them multiple ways that they can drive returns through the cycle. The last thing I want to talk about here is Deutsche's ability to tactically position the portfolio. So keep in mind here that the assets included in the strategy are mature brownfield assets. They have multiple years of usage data, and so the cash flows are going to be pretty stable and predictable. So when I first considered this, I thought that the most effective listed infrastructure strategy would be a buy and hold strategy. But what I didn't consider was that being able to tactically shift the portfolio can allow a manager to move away from securities when things like borrowing costs or macro trends turn unfavorably. And this can give us a more defensive portfolio, which can significantly impact performance over time. And Deutsche recognizes borrowing cost as the most volatile input into their valuation models. And they dedicate a significant amount of time and resources to understanding each company's true borrowing cost. They're regularly monitoring interest rates, sovereign CDS spreads, and corporate debt markets, looking for changes in the cost of capital that can affect the value and the returns of the underlying assets. There's also a top-down aspect to their process. They're looking at the business, economic, and credit cycles for the regions that they for the regions in which they invest, and they're looking to invest where economic growth is strengthening and where credit markets are stable, because they think that this provides for the least downside risk. So their focus on the return drivers, the cost of capital, and the macro inputs allows them to tactically position the portfolio in a defensive way that has been accretive to returns. Here we see the drawdown versus the markets. The Dow Jones Brookfield Index is indicated by the green line. Deutsche is in blue. And as you can see is that Deutsche has had smaller magnitude of drawdowns versus the benchmark during nearly every decline since May of 2011, which is the period of time that the current team has been in place. And then the value of this positioning is apparent when you look at the risk-adjusted returns. And so this is for the same time period since May of 2011. And what you see is that Deutsche has had a higher level of returns with less volatility than both the index and broad global equities. And here we have just a quick overview of cumulative performance versus the benchmark, noting the consistency of the outperformance for the time period that the team has been in place. I'm going to switch gears and discuss a few of the concerns that we had while we were underwriting this strategy. I want to walk you through those and let you know how we got comfort with them. The first, and Mr. Treasurer, this addresses your question, is whether or not listed infrastructure behaves more like infrastructure or more like equities. And so as I've said, listed infrastructure is a way to invest in the asset class that's going to get you most of those infrastructure characteristics that we want in a way that is quickly scalable. It does provide liquidity, we get a significant amount of diversification, and we have lower fees. So, however, it is, as we can see here, more highly correlated to the equity markets, which does impact the portfolio level of diversification we achieve. So, listed infrastructure has a long-term correlation to global equities of about 0.85 and to U.S. equities of about 0.79. But I do want to dig into those a little bit more granularly and show you how they behave in different market environments. So we've talked about the defensive nature of infrastructure assets and that they provide diversification when it's needed in down equity markets. And this becomes apparent in the drawdown experience of the index, which is indicated, the infrastructure index is indicated by the green line, and then the gray line is global equities. And what you can see is that listed infrastructure draws down less and recovers more quickly than global equities. And it really becomes apparent if you look at the up and down market capture rates since the inception of the benchmark all the way back since 2002. And you can see that infrastructure participates in about 90% of the up markets compared to global equities, and only about 63% of down markets compared to global equities. And one of the ways that they are able to do this is through stable growth of cash flows. Remember that these are core, they're mature core infrastructure assets that are operating under long-term agreements. And so what you can see is that cash flows are stable and predictable even when the equity market is under stress. And so I've put a box around the period of the financial crisis to note that listed companies, infrastructure companies, which is indicated by the green bar, had steady cash flow growth during this period compared to global equities, which is the gray bar. And so as it turns out, losing less in down markets, recovering more quickly during drawdowns, and participating in most of market upside has a meaningful impact on performance and risk-adjusted returns over time. And that's illustrated here. The Dow Jones Brookfield Index in green, as you can see, has outperformed the MSCI ACWI, which is the gray bar that you see. So the second consideration we had for this strategy involved the interest rates sensitivity that might exist. Just given the environment that we find ourselves in currently, we had some concerns about how the assets might perform during different interest rate regimes. So clearly higher interest rates mean higher cost of capital for all assets, which lowers valuations. But within infrastructure sectors, there are differences in how these assets react during a rising rate environment. And so given, again, the newness of the asset class, there was limited data on how listed infrastructure has behaved historically through different interest rate regimes. But then working with that limited data, we were able to isolate two periods of time since the inception of the benchmark, one when rates fell and one when rates increased, to gain an understanding of how these assets may perform during similar periods in the future. And just to orient you on the slide, the green line is the listed infrastructure index. The gray line represents global equities. On the left, you will see the period from July 2007 to January of this year, which was a period of historically low rates. And what you see is that at the start of this period, infrastructure securities did have some volatility, but after they found their footing, they went on to outperform global equities by a significant amount. And then on the right-hand side of the slide, this was the period from mid-2004 to mid-2007. During this time, there was a slow and steady rise in rates. And what you can see during this time is that infrastructure also outperformed global equities by a pretty good margin. And this is only 2 periods of time, but I think that there is a logical explanation for why why I think this should hold in the future. So if you think about some of the assets, electric, gas, and water utilities, for example, the cost of capital is passed directly through to the customers. And so sometimes it's automatic and sometimes there is a lag as they have to make a rate case. But as the cost of capital increases, you should also expect revenues to increase. Other infrastructure assets, while they're not regulated, they do have long-term contracts in place that directly tie revenues to usage volumes. And so this is the case for transportation assets, airports, and seaports. And so if you think about when rates are rising, you should also see an increase in, you should also see some GDP growth. And so these assets should benefit from an increase in usage, which should also increase revenues. Also, when rates are increasing, there is generally increasing inflation. And so I think it's important to note that about 80% of the infrastructure, of the listed infrastructure universe, has some sort of embedded inflation protection. This is the case for utilities, transportation, waste, air and seaports, and towers. So for these assets, you should expect that any negative valuation impact that comes from rising rates would at least be partially offset by the inflation escalators in the contracts. So this is apparent here where you can see that listed infrastructure, which is indicated by the green bar, is slightly below the, but in periods when inflation is slightly below the long-term average, which is about 2%, the average monthly return of listed infrastructure in this low inflation environment does slightly trail global equities, which is indicated by the gray bar. But in periods when inflation is above that 2% long-term average, what you can see is that listed infrastructure securities significantly outperform global equities, which is the gray bar. This is another reason why, and an example of why active management and asset purity is really important in this space. The infrastructure-related companies are not going to have contracts and regulation in place that's going to tie the revenues back to the cost of capital, the usage, and inflation. And then the last consideration we had was just to point out that while the strategy does have foreign currency exposure, the team readily admits that they're not currency experts and that the strategy is currency agnostic. And we're comfortable with this for a few reasons. Currency is a function of where a country is in their economic cycle. And as we just discussed, they're monitoring these cycles, and the metrics that follow along those movements are captured in their valuation models. And also to note that at least that more than half of the benchmark of the strategy is in U.S. dollar assets. But I do just want to note, going back to the attribution slide noted by the green bars, that currency really hasn't been a large contributor or detractor to performance over time.
What does that CCY stand for?
That's currency. I don't know exactly what the acronym is. If Josh wants to, but it stands for currency.
Actually, that's just kind of the standard abbreviation for currency. Little industry jargon that's not in there.
So it's the effect of currency changes on the return?
The green bars
in this
is.
diagram?
Yes, the green. What I wanted to show here was that currency. There is currency exposure that they're not actively monitoring or not actively trading into or away from. But over time, given how the metrics are picked, how the top-down macro inputs are fed into their valuation model, even though they're not actively trading around currency, it really hasn't had a huge impact over time.
And what the green bar is showing is how they are different than the benchmark and the impact that that has. So overall, a very small impact would show that they aren't taking much active risk whatsoever as far as currency goes.
And the fact that it's disappeared in the last year or so, is that just because it had no effect, or is that no data?
No, it's because they were slightly trailing going into what looks like 2014. And the active risk that they were taking had an improvement on returns. So it took it from that cumulative trailing up to a what we'll call insignificant impact.
And so just to wrap up, I'm making a recommendation for a $275 million investment into the Deutsche Global Infrastructure Security Strategy with a 55 basis point blended fee with custody at the Bank of New York in a separately managed account.
The infrastructure index seems to have had a much more significant slide over the past couple of years, more so than the ACWI. Could you speak to why that is? and then
Sure,
what you
there
see going
is,
forward?
there is a large portion of the index that is dedicated to midstream energy assets. So that's the pipelines and the storage and the distribution. And so while it doesn't have direct commodity exposure, it did get picked up as the commodity prices went down.
Where is the team located? Here or abroad?
In Chicago.
Oh, it's good.
Some organizational questions. I see
Okay.
that HEK has a qualified, and mainly around risk and operations. Is the separately managed account, is it truly a separately managed account, or is it some of these like Irish trust things that hadn't been tested in law, those things?
Oh, no, it's a separately managed account
Good.
with custody at the Bank of New York. We have,
That's right.
yeah, we'll have the assets.
I just couldn't tell from this.
Okay.
Are we investing with Deutsche Asset Management, which is an unfortunate acronym of DAM, or this REFI, or whatever the name is?
So REEF is the investment advisor. So REEF used to operate as its own entity. In 2002, Deutsche purchased that entity, and still now, for legal reasons, REEF acts as the investment advisor through Deutsche Asset Management.
Okay, and it says over here someplace, and I was too worried to go into that, but the legal entity responsible is the REFI, or whatever.
Yes.
So is that the group that, our counterparty, or?
Yeah.
Okay, so we're limited to their assets or, and their operation, I suppose.
Yeah, but if they pull Lehman, that might be a good thing.
And I should say,
Yes.
qualified is, so when we've fully underwritten a manager and it goes through operational due diligence, it'll get a buy, hold, or sell rating. When it has not yet gone through operational due diligence, we have this more quantitative approach that you're either qualified or unqualified. So qualified is a good rating. We've spent a lot of time talking with Ashley and her team about the manager. We're very comfortable with it. I just wanted to make sure you were clear that it wasn't some big concern
No.
that we weren't talking about. We're very comfortable with this manager
And the
overall.
last one, and these are, the publicly traded 80% institution, 20% retail. Is that Deutsche Bank, or is that the?
I'm
Manager.
not sure. Can you say it again?
It says business and the ownership, and it doesn't really tell you which. I'm just trying to follow this. Is that Deutsche Bank Asset Management that is publicly traded, 80% institutions, 20% retail? Or is that this legal entity?
That's Deutsche Bank.
That's going to be Deutsche Bank.
Deutsche Bank? Okay, good. Thank you very much, Ashley.
Yes, yes.
Any other questions, discussion for Ashley? If not, Mr. Hitchcock, do you want to read the motion?
Yes, sir. In regards to Deutsche Global Infrastructure Securities, A, adopt the recommendation of the acting CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated April 21st, 2016. B, authorize an investment of up to 2.5% of total planned assets into the Deutsche Global Infrastructure Securities through the use of a separately managed account agreement with an anticipated initial investment of $275 million. C, authorize the chairman or his designee to negotiate and execute any necessary documents to implement the investment as approved by the commission, 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3-day business review period as approved by the commission on May 1st, 2014. D, authorize the chairman and/or the acting CIO or the designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the retirement trust fund's obligations with respect to the investment.
We have a motion to approve.
Guess I'll make a motion.
Okay, second? Okay, any further discussion? All right, hearing none, all those in favor of the motion signify by saying aye. Aye. Reynolds, are you saying aye?
Aye.
Okay. Opposed? None opposed, the motion's carried. All right, Mr. Hitchcock, what's next?
I believe we have, Mr. Chairman, I believe we have lunch. And if it would be my recommendation that we take a few minutes that we move to go into executive session, but prior to doing that, we take a couple of minutes, grab our lunch, and maybe eat through executive session.
All right, want to get our lunch and then make
Yeah.
a motion to go into executive session?
Or we can just make the motion now, and then as soon as everybody's settled, we can just,
All right,
we'll secure the.
Why don't you?
Yeah.
why don't you read the motion?
Okay, the motion to go into executive session to discuss investment matters pursuant to SC Code Sections 9-16-80 and 9-16-320, to discuss personnel matters pursuant to SC Code Section 30-4-70, and and to receive advice from legal counsel pursuant to SC Code Section 30-4-70A2. That's the motion.
All right, motion to approve. Second. All those in favor? Aye. Opposed? None? Okay, we will go into
Yeah.
executive
Okay.
session. We will adjourn.
Okay, that's, yeah, no, and just for the record, there was no action taken in executive session.
We are adjourned.
We're adjourned. 2:31. Good job. We're on.